I'm Al Brooks. Thank you for watching the Brooks Trading course. This is the first of 5 videos on breakouts. I'm going to begin by talking about exactly what I mean by a breakout. I'll then talk about my 80% rule, and that is in part that 80% of breakouts fail. Next, I want to make a point about every reversal being a breakout. And finally, since breakouts fail in a trading range, traders need to buy low, sell high, and scalp. A breakout is simply a trend bar, or a series of trend bars. So every trend bar that you see on the chart is a breakout, and sometimes you get a series of trend bars and they form a breakout. Bear breakout there, bull breakout here. It can be one bar, and it can grow into several bars. A breakout always is a move beyond some kind of support or resistance. If you have a bull breakout like this, there are several resistance levels that the market is breaking above. First of all, the high of the prior bar is always resistance. Next, you have a lower high. Next, you have a trend line. Next, you have the moving average. Here, we had a double bottom and a bear breakout. Small head and shoulders top, left shoulder, head, right shoulder, and it failed. And the bulls were able to get a micro double bottom. So the bears tried to sell off, and the bulls bought. The bears tried to sell off again, and the bulls bought even more aggressively, creating a good buy signal bar. In this particular case, the market broke below a double bottom, and then it broke back above. So that is a breakout back above a double bottom. As breakouts grow, they tend to go above higher and higher resistance levels in the case of a bull breakout like here. At this point, it broke above the moving average and finally got a close above the moving average. I always look at trend lines, and there are different ways to draw them. I could use these two highs, or I could use this high and that high. And clearly, the market is breaking above the trend line as well. So the market's breaking above a bear trend line. I said that it broke above the high of this bear bar, but I also look at prior lower highs in a bear trend. And the more resistance that the market breaks above, the more likely the breakout will have follow through and a second leg up or multiple legs up. So we're breaking above a prior lower high. And then we broke above another lower high. At this point, you can call this a trading range. Every head and shoulders top, left shoulder, head, right shoulder is a trading range. Maybe the trading range began here. We went down, we went up, we went down, we went up, down, and up. It's a lower high, but it's also a trading range. So we broke below the range, and then we broke above the range. My 80% rule is that markets have inertia, and 80% of the time they resist change. So 80% of the time, if the market's in a trend, reversal attempts will fail. And 80% of the time, if the market's in a trading range, breakouts will fail. And that is the reality. So the market broke above this low, reversed up, broke above this high, reversed down. And it's just repeatedly reversed breakout attempts. New high, failed. New low, failed. We tried to reverse up, failed. Broke to a new low, failed. Broke above this high, failed. Above this high, pulled back. This high, we pulled back, tried to reverse down, tried to fail. Here we tried to reverse down, and we succeeded. We broke below the bottom of this strong rally. But the breakout failed. Also, a really important point about breakouts is that on any chart, any time frame, only about 10% of the bars will be in a strong breakout that actually has follow through. So you can look at this chart, maybe it has 100 bars on it. And we have a few bars down here, a few bars up here, a few bars down here, and a few more bars down there. But only 10% of the bars actually have follow through. So this sell-off had a little bit of follow through. This buying had a little bit of follow through. This sell-off had a little bit of follow through. Most of the bars, 90% of the bars on the chart, are either in channels or in trading ranges, even if the bars are pretty big trend bars. When the market's in a channel or a trading range, 80% of the breakouts will fail to get very far. On this slide, we have a pair of pretty good bull bars, especially this bar, followed by a bear bar. And then we have a bull flag, a 1-bar pullback. You can call it a 2-bar pullback. We started the pullback here. This bar pulled back below that bar, so this is technically a pullback on this time frame. And it's about a 50% pullback, and it's a bull bar. Tail on top following a big bear reversal bar, not a high probability buy, but the market's still always in long at that point, and it is a high one bull flag, so it is a buy setup. But bull flags like this very commonly have breakouts that fail and reverse down. So a lot of traders will buy on a stop just above the high of this bar, taking a chance that if the breakout is not successful, maybe we'll pull back for another bar or two, hold above this low, and then resume up with a high 2 or a high 3. As I said, this is a high 1 bull flag, but a pretty prominent tail above and a prominent tail below. The body is less than half the height of the bar, so I would call that a doji bar. And if the bulls see this bar, their entry bar, they're going to be disappointed. They don't want to see a bear bar, and they don't want to see a bar closing below its midpoint. Well, that tells us that in this particular case, there probably were more sellers above the high of this bull flag than buyers. Bears will see that, and instead of buying this breakout, they'll sell it. The bears are betting that most breakout attempts will fail, and that this is a fairly decent reversal after a small 2-bar breakout, and it's a bad-looking buy signal bar. At a minimum, it's possibly a reasonable scalp, betting that the breakout, the first reversal up from the pullback, will fail. Here we have a bull breakout and an attempt to make the breakout fail. And by this bar going below the low of that bar, it triggers a failed bull breakout. A lot of traders will sell on a stop below that bear bar, betting that the bull breakout will fail and reverse down. A lot of traders will sell that, betting that the bull breakout will fail. Now remember, every reversal is a breakout of something. So we have a bear bar, and you should think of it as a breakout as well. If I were to draw a trend line up from the low of this bar to the high of this bar, it would be vertical. Or I could draw a trend line from the low of this bar to the high of that bar, and it would be a trend on a smaller time frame chart, and this bear bar is a reversal down. My point is that whenever I see a reversal down after a bull breakout, I think the reversal down is a bear breakout. I think of it that way. I think of it as if there was an obvious breakout here. Clearly, there's not an obvious breakout here, but it's a reversal attempt, and I think of every reversal attempt as a breakout. Now, which breakout is stronger, the bull breakout or the bear breakout? Clearly, the bull breakout is stronger, and therefore it's not a particularly high probability sell below that low. Bears will take the sell, taking a chance that will just keep going down, knowing that the probability is low, but their risk is low as well. They're putting a stop above the high of the bar or above the high of the bull breakout and taking a chance that it's the start of a big bear trend. Low probability, great risk reward. This bear bar might not be strong enough to reverse that. So there might be more buyers than sellers below the low of this bar. And clearly, if you're a bear and you shorted, you do not like the bull close. You do not like your entry bar failing to become a big bear bar closing on its low. So a lot of bears are disappointed. Bear trend tried to resume down again here, and they have a bear bar, but a much weaker bear bar, big tail on the bottom of the bar. So we had a bear bar here, tried to get a bear breakout, got a bull bar. We had another attempt at a bear breakout, could not close below the low of the prior bar, just like this could not close below the low of that bar. And here we have a close at or above the midpoint of the bar. So this is not a very good looking breakout. It's telling us that there might be more traders believing the opposite. So the bears sold, betting that the bull breakout will fail, but it looks like there probably were more bulls buying at the low of this bar, betting that the bear reversal would fail, which is logical because most reversals fail, most breakouts fail, most reversals fail. Now, if a trader thinks that buyers will win above or below a bar, he should buy. Look at this rally. We have 3 bull bars, not great, big tails, but 2 of them closed well above the midpoint, and this one has a pretty good sized body and a close above the high of the prior bar, so there's a gap there. Is this going to be a failed bull breakout? It's a low probability short. There probably are more buyers at the low of this bar than there are sellers. So some bears will sell, looking for a move below here and a measured move down, but probably 3 consecutive bull bars, probably more buyers than sellers below, so probably more traders would buy. However, because of the absence of big bull trend bars closing on their highs, we have prominent tails, a couple small bars, the bulls know that there might be a deep pullback and a trading range. So it's okay to buy if you use the correct stop. Here, at this point, we have a pair of bull bars, this one closing on its high, and it's a higher low. This is a higher probability buy than there, but both are appropriate buys. So here, bulls thought pretty strong rally, probably buyers below. At this point, they see a higher low with 2 bull bars, and they're thinking that, well, there are probably buyers above this bar as well. So buyers below that bar and buyers above this bar. A seller, the exact opposite. If he thinks that the sellers will win, he should sell. So for example, he might say, not a very good rally. The buy signal bar has a pretty prominent tail on top. We have a micro double top, up and down, up and down. Maybe we'll enter a tight trading range. Maybe I'll sell above the high of this bull bar. It has a fairly prominent tail, and I'll sell there. And maybe I'll sell below this bear bar. Now we have another version of a micro double top or a micro triple top. Up, down, up, down, up. And if we're going down again with a bear bar closing on its low, it's a second entry sell for the failed bull breakout. Bull breakout, first entry sell. And then we went up again. Now we have a better looking sell signal bar. That is a higher probability short than selling below that bar. So you have bears selling above this bar and selling below that bar. A lot of the time, if not most of the time, traders are fairly uncertain what to do. That's the nature of markets. They strive for confusion. And if at any time you're not sure, then just wait. Should you buy above this bar? Should you sell above this bar? Should you buy above this bar? Sell above this bar? Should you buy or sell below that bar? If you're not sure, best choice is wait. I mentioned examples of support and resistance that can lead to breakouts. Does it matter what type of breakout it is? A break above a prior high or low, a trend line, a moving average? It doesn't matter. All that matters is that there's a breakout. And a lot of times, if you're a beginner, you don't even see what's being broken out. But again, it doesn't matter. If the breakout is strong enough, you don't need to see or understand what's being broken. Remember, every trend bar is a breakout. Every series of trend bars is a breakout. And the bigger the bars, the more they close on their high. If we're talking about a bull breakout, the stronger the breakout and the more likely there'll be at least a 2-legged move. Here, 3 pushes up, 1, 2, 3. And we have a bear bar, so it's a breakout. It's a reversal. Every reversal is a breakout. And then this is clearly a breakout. But a breakout of what? Of many things. It's a wedge top, so it's a break below the bottom of the wedge. It's a break below the trend line. Here we have a very big bull bar. A lot of bulls will put their protective stop just below its low. So it's a breakout below the bottom of a very big bull bar, a biclimax bar. Here we have a rally, not nearly as strong as the sell-off, and bad follow-through. We keep getting pullbacks. Here we have a little triangle, a bull breakout above the triangle, reversing down. So this is basically a bear flag. So we have a small early bear trend, and we tested back up. Traders will view it as a bear flag, and they'll look to sell a breakout below the bear flag. They'll also look to sell a breakout below this low, below that low, below the trend line at the bottom of the trend. You can see we're failing at the 60-minute moving average. This is a 5-minute chart of the euro versus the dollar, and we're failing to break above the 60-minute moving average. We failed to get above it here, 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 and then here, and then here, and now we're starting to reverse down again. Bear breakout, tried to reverse up, so a small bear flag, and this is a breakout below the bear flag. Another small bear flag. Then at the bottom here, we have a spike and channel bottom, bear breakout, spike, 3 pushes, 1, 2, 3, so a small wedge bottom after a bear breakout. And then we're trying to reverse up again. Every bull bar is a trend bar. It's a breakout, it's a climax, and this is a little bull breakout above the top of a wedge bottom. Channel is tight like this. Probably even a strong reversal up like this is going to be minor, a bull leg in a trading range, rather than the start of a bull trend. That means that the rally probably has to test down. Here, we got a higher low. The bulls are hoping for a trend reversal, not likely when the channel down is this tight. You can see here we broke below that low. But then we broke above this high. Is this a major lower high in the start of a bull trend up here? No, it's not a major lower high. It did not result in a strong reversal down. It did not result in a new low. So it's a minor lower high. A breakout above it probably will not get very far, and it did not. It reversed down on the next bar. Another leg down, another two-legged rally, low 1, low 2, so another bear flag. Break below the bear flag. And then we have a double bottom attempt. We got a bear breakout, so that's a wedge. 3 pushes down. Every double bottom is 1 push, 2 pushes down. If the market breaks below it, that's a third push down. So even though it does not look like a wedge, it's a wedge. And it's a nested wedge because it's within a larger wedge. 1, 2, 3. And then we have a bull trend bar, so we're getting a reversal up. We're trying to break out above a wedge bear channel. Trying to form a micro double bottom. Got a bear breakout. And then we have another attempt at a bottom. We broke below it, but immediately reversed up. At this point, a pretty strong bull breakout, well above the moving average. There are gap bars here, gaps between the lows of the bars and the moving average. And therefore, the sell-off that tests the low of the bear trend probably will be the final leg down before we get an attempt at a major trend reversal. And here we got a higher low major trend reversal and a second leg up. We got a bull breakout and a pullback around 50% bull flag. The sell-off is weaker than the rally. And we have a wedge bottom, so probably 2 legs up, 1 pullback, 2. And this is also a higher low major trend reversal. So bear channel, bull flag, we got a bull breakout. Then we got breakouts above minor lower highs. A double top attempt by the bears, double top, neckline, bear breakout? No. We have a double top, and instead we got a bull breakout. And then we got a breakout above this high. A wedge rally, 3 pushes up, 1, 2, 3. Other ways to count it, 1, 2, 3. In any case, it's a bull channel, and this is a break below the bull channel. Did not get very far. Now we have a bear channel, a bull flag, and this is a breakout above it, not particularly strong. And then we got another bull channel, and we broke below it. We have an attempt at a higher low and broke below it. I'm telling you that every trend bar or series of trend bars is a breakout. And a lot of times you look at the chart and say, well, I don't know what's being broken out. Well, there's something being broken out. This chart is an example of a lot of little things that are being broken out. And I'm just trying to explain what a lot of the computers are seeing. The computers are looking for breakouts, and these are the kinds of things that different computers look for. Most of them are minor, and most of the breakout attempts fail. A breakout, it can be a single trend bar, and there are many terms for the same thing. You can call this a strong trend, or strong trend bar, strong series of trend bars, a breakout, a spike, a climax, a gap, a reversal. This could be a reversal. We could have gone down here and then up here. It's all the same thing. Those are all synonyms for trend bars. This is a bull trend bar. Now, which term I use depends on what took place over here to the left. If the market was selling off and reversed up, I would call this a reversal. It's still a buy climax. It's still a bull breakout. It's still a spike. Probably has some kind of a gap between this close and something, the high maybe of the prior bar. But all that really is important is it's a bull trend bar, and so it's a breakout. Even if you don't know what's being broken out, you see a bull trend bar, it's a breakout. Consecutive bull trend bars, it's a breakout. It's a stronger breakout because not only do we have higher price, we have more time. The market has been breaking out for a longer period of time. 3 consecutive bull trend bars. Now we have 3 consecutive bull trend bars, even a stronger breakout. The reversal down, probably minor. It's big enough down, so we have a big up, big down reversal. We probably have to go sideways for a few bars. But this chart is still always in long. Every breakout, no matter how strong, eventually tries to reverse. But most reversal attempts fail. I've said a couple times today that every reversal is a breakout. Again, a lot of times it doesn't look like a breakout. It just looks like a reversal. And it doesn't matter if you call it a reversal or a breakout. There is a breakout there. Here we have a bear trend bar. So immediately think breakout. What did it break below? Well, it broke below this 3-bar bull channel. It broke below the low of this bar. Does not matter. Anytime I see a big trend bar, a bear trend bar, I think breakout. And again, the choice of the term depends on what took place to the left. Here we were rallying. Now we have a big bear trend bar. So I would refer to that as a reversal, but it's still a breakout. We have a bull breakout, and this represents a failed bull breakout. Whether that will lead to a trend or a trading range, or a pause in the trend and a bull flag and trend resumption up, too early to tell. But it's a bear reversal, it's a failed bull breakout. I've made this point many times throughout the course, that breakouts are common. Every trend bar, every series of trend bars is a breakout. Lots of bull breakouts. This is a big bull breakout made up of many smaller bull breakouts. Bear breakout, other bear breakouts. Some have 2 bars, some have more, some are just, here's 3 bars. Do I count that as part of the breakout? I typically do not. To me, that's a pause bar, and then we accelerated down, so I would call that the breakout. Markets have inertia. That is my 80% rule. And by inertia, what I mean is the market tends to continue to do what it has been doing. So anytime I see a breakout like this, I look to the left. Trading range. Chances are the breakout will fail or eventually fail. If I'm looking at a reasonably strong rally and I see a breakout here, chances are we're going to get some follow through buying, because bars to the left, we've had 7 bars up, 7 bull bars. Now, every tail on every bar is a breakout. This tail below, at one point, this was a bear trend bar with a close down here, but by the time the bar actually closed, it became a bull bar. The market traded below this low. We have a bear trend, small rally, bear flag, and it was a break below the bear flag, and it failed. Now we have a low 2 bear flag, and these bars all have tails below. That means they all represent failed breakouts. Tails at the tops of bars, failed bull breakouts. We have a bull flag. We tried to break out, failed. Tried to break out, failed. So every tail is a failed breakout attempt. Trading range breakouts, like I said, the markets have inertia. And if the market has been going sideways, chances are it'll continue to go sideways. And 80% of attempts to have it break out into a trend will fail. 5-minute chart, euro versus the yen, up and down repeatedly. Here we have a decent bear bar and good follow through at the bottom of the range. At a prior low, we reversed up. Here we have a bull breakout to a new high, and look at the follow through. Strong bull bars trap traders into buying high. Bulls are hopeful. Like you see a bar like this, you say, oh wow, this is clearly going to be the end of the trading range and the start of a bull trend. Well, it's not. Most trading range breakouts fail, even very strong ones like this or like that. Beginners, they tend to buy these bull closes, betting on a successful breakout, forgetting my 80% rule that most fail. Smart bears, what they do is when they start to see strong bull bars, big bull trend bars near the top of the range, they look to sell. They can either sell with stops on a reversal down, like below that bar, below this bar, or a lot of them will look at strong bull closes and sell the market. So as soon as that bar closes, they hit sell the market and they get filled on the open of the next bar. Every breakout is a climax when it's at the top and a sell climax at the bottom. And 80% of those breakouts will lead to reversals. And a reversal is simply a trend bar in the opposite direction, which is a breakout. I said bears will sell strong bull closes near the top. They'll also sell reversals down, which is slightly higher probability than selling the bull closes. A pair of very strong bear bars at the bottom, terrible follow through. Another bear breakout attempt, another one, and they're all failing. Very strong bear bar closing far below the low of this bar, but still within the trading range. Bars like that trap traders into selling low. Traders are naturally hopeful and then thinking, wow, that's so strong. This has got to be the start of a bear trend. And look at this. We had an extremely strong bull bar, and now we're breaking below the low of that bar. So certainly this will end up as a measuring gap and lead to a big move down. Well, it did not break below the low of the trading range, and the next bar has a bull body. Chances are this bear breakout will not get very far. And the bulls know that. So every time they see a big bear bar closing near the bottom, well, they're going to be buying those bear closes, betting that the 80% rule will apply, that bear breakouts will fail. Every big bear bar that looks like a strong breakout and the start of a bear trend, they buy. They bet that 80% of the time those breakouts will fail. Other bulls prefer to buy reversals up, so they'll buy after the breakout reverses up above bull bars here, 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 and here. I began talking about what exactly I mean by a breakout. I then moved on to my 80% rule, that 80% of breakout attempts will fail. Next, I made a point that every reversal is a breakout in the opposite direction. I may not call it a reversal, and I may not call it an opposite breakout. I typically call it a reversal, but it is a breakout, even though it may not be obvious on the time frame in front of you. And finally, because of the 80% rule, if the market's in a trading range, it does not matter how strong the bull bars are at the top or how strong the bear bars are at the bottom. The breakouts are probably going to fail, so traders buy low, they sell high, and since they expect the trading range to continue, they scalp, they take quick profits. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 5 videos on breakouts. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on breakouts. An important point that all traders should understand is that for breakouts to be successful, they need follow-through instead of a reversal in the next bar. Trends are always trying to reverse, but if they have good follow-through, chances are they will continue at least a little bit further. The final point I want to make is that breakouts can begin as small bars or a series of small bars. They do not have to begin with a big trend bar. After every breakout, traders like to see confirmation. Here we have a bull channel, bear flag. I think of every bull channel as a bear flag, every bear channel as a bull flag. In other words, a bull channel, chances are it's going to get a bear breakout. Well, here's a bear breakout. If it's only a single bear bar, chances are it's not going to lead to a reversal. It'll probably lead to a trading range, maybe another leg up. So the more consecutive bear bars, the bigger the bear bars, the more they close on their lows, the more likely this is going to lead to a swing down. Next bar, this is the follow-through bar. The first bar is the breakout bar, and the next bar is the follow-through bar. Sometimes the follow-through bar can be the second or third or fourth bar. In any case, with a strong follow-through bar like this, a bear bar closing on its low, close below the low of that bar, consecutive bear bars closing on their lows, decent-sized bodies, it increases the chances that this is a measuring gap and that it will lead to a measured move down from this high breakout point, and it fell more than a measured move down. On the other hand, here's another attempt at a bear breakout. We have an attempt here. We have another attempt here. We have a bull trend. So we have a spike and small channel, and then we have a bear breakout. But a couple of problems with it. Tail on the bottom of the bar. And look at the follow-through bar. It's a reversal bar. This bar, tail on the bottom, not especially a big bear bar, and close at this low instead of far below that low. So the bear breakout is not very strong. And the next bar is a big bull bar closing on its high. So it's totally reversing the bear breakout. Now, remember I said that anytime I see a trend bar, up or down, I think of it as a breakout. Now, you can call this a breakout, or you can call it a failed bear reversal. Breakout of what? A bull flag. It's a high one bull flag. We trended up, we pulled back, and this is a high one buy signal, and we traded above it. And some bulls will buy here. Other bulls will buy above a bull bar. So a 2-bar reversal, down, up, and then they'll buy here. Main point, bear breakout, terrible follow through, unlikely to go down. Here, bear breakout, good follow through, probably get at least some follow through selling. Yes, some bears who sold this close, and not a high probability sell, but probably good risk reward. Maybe they put their stop above the bear bar, maybe above this, hoping for a huge move down. So big reward, not big risk. But whenever you have great risk reward, you have terrible probability. With this close at this low instead of below the low, and with no follow through bear bar yet, the probability of selling this close is low. Whenever you get these bear breakouts like this and like this, low probability to sell here, but once you get a strong follow through bar, it confirms the breakout and it increases the probability that prices will continue down. Here, we have a bear breakout and terrible follow-through bar. Instead, we got a good reversal up. A lot of bulls, when they see a bar like this, knowing that the bears need a strong follow-through bar, they bet against it. Most reversals fail. We have a bull trend. Most reversals fail. And most breakouts fail. We're trying to break below a bull trend line. Some bulls will buy that close, betting that the next bar will not be another bear bar. So the bulls buy that close, betting that the bears will not get their follow-through bar. Some bulls bought this close, the bears got their follow-through bar, and a lot of the bulls who bought that close exited here. And they're not going to buy again for at least several bars. That means no buyers immediately below, and the market has to go lower to find buyers. Bear breakout, the bulls know the bears need one more bar. The bulls will buy that close, and if the bears get their second bar, as they did here, the bulls will take their loss. They'll sell out with a loss. Whenever there's any kind of a breakout, traders want to see confirmation. Bear breakout, confirmation increases the probability we're going lower. Bear breakout, no confirmation. Here we got a bull breakout. New high above this, new high above that. And look at the confirmation. Bad confirmation, no confirmation. It's an attempt at a reversal instead of a strong follow-through bar. Bull breakout, and then you get a bear bar. It's a failed bear breakout. Bear breakout, followed by a bull bar, is a failed bear breakout. Strong trends are always trying to reverse. Here we have 10 or 15 bars below the moving average. We have 5 consecutive bear bars here. And in these 9 bars here, we only have one bull bar. Bull's trying to reverse up again. And decent bull bar, closing above the high of this bar, and closing above the high of maybe 6 or 7 bars. But that's the breakout bar. The bulls need at least one more bull bar to convince traders that they have taken control. What do bears do? They sell that close. Also, anytime the market's in a bear trend below the moving average, and there's a bull bar closing near the moving average, bears sell the close. They sell that close. They sell the close of any strong bull bar at the moving average, betting that 80% of trend reversal attempts will fail. So chances are this bull breakout will fail, and the next bar, instead of being another bull bar, a follow-through bar, it'll be a reversal. Whenever you look at a reversal and you think, gosh, I think the bulls need one more bar. Well, bears will sell that close, betting that the bulls will not get their one more bar and that the bear trend will resume down. Same thing here. Big bull bar near the moving average. Most bull reversal attempts will fail in a reasonably strong bear trend. Fairly tight bear channel holding below the moving average. I would rather sell the close of that bull bar than buy the close. I would bet against the bulls getting their follow-through bar. Same here, same here. And what about here? We're finally above the moving average, and we have a bull breakout above the high of the past 30 bars maybe, and we have a bull follow-through bar. Well, bears would sell that one as well, arguing, yeah, bull breakout, but look at the rally. Where are the consecutive big bull bars? Here we have consecutive bull bars, but they're not especially big. So this entire rally is probably a bull leg in a trading range. Bear trend lasting 50 or 60 bars. Gap bars. A gap between the low of this bar and the moving average. Gap bars here. Usually gap bars mean the market will have at least one more leg down. They're a sign of the bulls becoming stronger. The bulls are strong enough to put bars completely above the moving average. But when you're in a bear trend, the first time the bulls do anything, bears sell it. So first time you get a big bull bar, the bears sell. First time you touch the moving average, they sell. They were willing to sell below an average price for all of these bars. And now they finally get a chance to sell at the average price. They're going to sell. First time the market creates gap bars, bears will sell, betting that the reversal attempt will fail. Other bears, instead of selling strong bull closes, they wait for reversals down. We have a bear trend, leg 1, pullback leg 2, bear bar closing on its low. They'll sell below the low of that bar, stop up here. They'll sell below the low of this bar, stop up here. Bulls tried to reverse up, bears resume down, so they'll sell below the bull bar or below the bear bar. Some traders prefer stop entries, selling below bars once the reversal attempt up fails. Same thing here. Bears getting a breakout, but they probably need one more bar. We broke below the moving average. We broke below the low of the prior bar. We broke below this double bottom, but close at these lows instead of far below. Close off the low of the bar, not all that far below the moving average, and we're still holding above the bottom of the bull trend. If you're a trader and you're looking at that, what's more likely, that we're going to continue down or that this bear breakout attempt will fail? Probably will fail. And because of that, as soon as the bulls see this close, they hit buy the market. So they get filled either right on the close of the bar, if they buy right before the bar closes, or they get filled on the open of the next bar, betting that the breakout will fail and that maybe we're getting a higher low major trend reversal. Bull breakout, two-legged pullback, so a large high 2 buy, leg 1, pullback, leg 2. And the bulls who did take that bet, betting the bears would not get good follow-through, they won. Above the moving average for 10 or 15 bars, above a bull flag, bear channel, bull flag. Guess what happens when you get a bear reversal bar near the moving average? The opposite of what I talked about in the bear trend. The bulls will look at that and say, ha, I don't believe it. Most reversal attempts fail. I'm going to buy any big bear bar closing near the moving average. So I'll buy that, and I'll buy that. I'll buy that. Because the bears need one more bar to convince traders that the bears have taken control. And because of that, bulls buy those bear bars, betting that instead of a second bear bar, the market will resume back up. Trends constantly try to reverse. But my 80% rule, 80% of reversal attempts fail and become flags, and then the trend resumes. Strong bull trend. Look at all the reversal attempts. Pretty decent bear bars all the way up. But a reversal attempt needs follow-through, and the bears are not getting their follow-through. And without that follow-through, nobody believes the reversal attempt will fail. Typically, at a minimum, traders want to see a bear bar following the breakup. They want this bar at a minimum to be a bear bar. And here we could not even get that. Ideally, what the bears want is a second bear bar. They want a big bear bar. They want the bar closing on its low. And then they want a third, fourth, fifth bear bar. But here we got a bear breakout, terrible follow through. Bear breakout, terrible follow through on the next bar. The bulls see every one of these breakout attempts as the end of a bull flag. So bull trend, bear channel, bull flag. So they look to buy a reversal up. Bear breakout, bull flag. Sideways, bull flag. Pullback, bull flag. The bears see reversals, the bulls see bull flags, and the bulls are looking to buy reversals up. Buying these bear closes, it's slightly lower probability than buying above the bull bar on the reversal up. So the market order has a lower probability of success than the stop order, but the risk is less as well. The bears are hoping for a follow-through bar. The bulls buy that bear close, and if the bears get their follow-through bar, the bulls exit. So the bulls in general are risking one bar. So aggressive bulls buy the closes, betting that the bears will fail to get their follow-through selling. And other bulls who want slightly higher probability, they're willing to pay for it with slightly greater risk, the stop being further away, but it's still just as valid as taking the more aggressive buy at the bear close. One has better probability with worse risk reward. The other has better risk reward and lower probability. A chart is made up of price and time axes. And sometimes a trend can begin more with time than with price. So sometimes the breakout can be small, but it can still lead to a big trend. So here we have a wedge bottom bear channel. Think of it as a bull flag, 75% chance we're going to get a bull breakout. Well, this is the bull breakout. And at this point, it does not look remarkable, but this is what followed. So a lot of times, even a single bull bar can be the start of a big trend. So we got a bull bar. We got a follow-through bar here, good for the bulls, but it's just a doji. It really didn't get clear until here, where we had a pair of consecutive bull bars closing near their highs. But in any case, a big bull trend can begin with a very small trend. Sometimes a single bull trend bar can be the start of a trend, and then sometimes a series of bull trend bars can be the start of a trend. Look at this. From this bar to that bar, no pullback. So it's about a 10-bar bull microchannel. On a higher time frame chart, this entire rally is a breakout. So if this is a 15-minute chart, on a 60-minute chart, or a 2-hour chart, or a 3-hour chart, it would simply be 1, 2, or 3 big bull bars closing on their highs. Sometimes a single bull bar can be the start of a breakout. Sometimes a series of bull bars can be the start of a breakout. All trends are in channels. This is a very tight bull channel, but this bull trend is in a channel. This is, on the left, a bear channel. Now, all reversals are breakouts. Here we have a small bull reversal. And is it a breakout? Well, it is. It's a break above the bear trend line, so it's a break above the channel. And it's also a wedge bottom, or you could say a double bottom with a failed breakout, which is a type of wedge bottom. So every reversal is a breakout of something, even if it's not clear. When you get follow-through buying like this, I view this as a give-up series of bars. The bears are giving up. And what happens is you get bears who doubt the bull breakout will succeed, and they sell. And they sell more higher. And at some point, they conclude that they're going to lose money. So they give up. And this pair of bull bars, consecutive bull bars, gap below that bar, the high of this bar. This is probably the give-up bar, where the bears gave up. They bought back their shorts. And it's also probably where the bulls who are waiting for high probability bought. You have bulls buying here, and you have bears buying here, and both are buying aggressively. The bears are desperate to get out of their losing trade before the loss becomes too big. And the bulls at this point realize the market has a high probability of going higher, so they're buying aggressively, and this is what followed. And it created a big bull breakout. Give up bars, the bears finally giving up, taking their losses. And the bulls know the bears are doing that, and the bulls buy aggressively because they know if the bears are buying back their shorts, the bears are not going to sell again 1 or 2 bars later. They'll wait for at least several bars. So it's a high probability buy. 60% or higher that there'll be at least some kind of a measured move up, maybe a measured move based upon the height of this trading range. It obviously went much higher than that, but the context is good for the bulls, and they have a good breakout and good follow-through bar. Chances are 60% we're going up for some kind of a measured move. Stocks, here's Amazon, daily chart of Amazon, often have big gaps on the open. This day opened far below the low of that day. You can see there are just gaps in many different places on the chart. Every gap is a breakout, and it can succeed or fail. So here we have a big gap down, and it ultimately reversed up. Here we have a big gap down, ultimately reversed up. Here we have a small gap up, it reversed down. So any gap, like any other type of breakout, can succeed or fail, and traders look at the price action and try to determine what is more likely, a successful breakout and a new trend, or a failed breakout. On Forex charts, gaps are much less common, and they're, in general, not particularly important. Sometimes they are, but for the most part, they're not. So a big gap down below yesterday's low. Today's open's down here, and that's yesterday's low. Big gap down, and it failed. The stronger a breakout is, the more likely it's going to lead to a trend. Here we have a pair of small bull bars, not particularly strong. And then we have a bigger bull bar closing near its high. And we have gaps. This close above that high, this close above that high, and this close way above this high, so the trend is getting stronger. And the entire 3 bars is also a breakout. This is a breakout, this is a breakout, this is another stronger breakout, and the 3 bars, some computers look at the entire 3 bars as a breakout. And here's the follow-through bar. The minimum that the bulls want to see is the absence of a bear body. And they got it. They got a bull body. That increases the chances that we'll go higher, even if we pull back first. They got additional follow-through buying here, and then continued follow-through buying for the next 20 bars. One big disadvantage of breakouts is the stop is usually far away. I said the probability of making money is high if you're buying a strong breakout like this for any reason, buy closes, buy at the market. Probability of getting some kind of a measured move up is 60% or higher. So what's wrong with the trade? Well, the stop is far away. Anytime you have a high probability trade, you're going to have bad risk reward. Usually that means big risk. The stop is far away. Also, the market suddenly is moving quickly, and unless you've traded a long time, it can be very difficult emotionally. You say, my gosh, I don't know what to do. I'm afraid this is moving so fast. Maybe it'll move just as fast back down. Traders get paralyzed by fear. One of the important things in this course that I talk about all the time is that you're always looking for reasons to trade. There's lots of trading taking place on every bar, on every chart. But a lot of times you don't know what to do. Do I buy at the market? Well, it's good to have behaviors that are fairly easy to execute. And here, this is a good buy the close bull trend. So as soon as you see a bull close, you can buy. If you did not buy that one, if you see another one, buy. If you did not take those two and you see a third one, just hit buy the market and put your stop in the right place. Since your risk is big, you have to trade small. If you're starting out, you look at this and, Al's giving me good advice. I can just buy these closes, put my stop down here, and 60% chance I'm going to get a measured move up. So if I buy here, here's my risk, 60% chance we're going higher. If I buy here, here's my risk, 60% chance we'll get to a measured move based upon this close. Every step of the way. If you buy here, 60% chance it'll go up for a measured move. If you buy here, the breakout's even bigger, so now the target is even higher. If you buy here, the risk is bigger. It's a logical buy. Chances are the target now is even higher. And it looks easy to do, right? But it's hard to do emotionally, and it takes a while to get used to it. And the most important thing is to trade the I don't care size. You trade small enough so that you truly do not care if you lose. I always talk about risk. Risk usually means price, dollars, but a component of that can be time. If you feel rushed into making a decision and it interferes with your ability to make the decision, that is risk. So if you feel pressured, you think that the chance of making a bad decision is higher, that is risk. Now let's say you buy for any reason. Where do you exit? Well, as long as your premise is still valid, you can just keep holding. Some traders will exit and they'll just scalp and buy again, scalp, buy again and scalp. But most traders cannot get back in once they get out. So whenever you have a strong breakout, it's usually better just to put the appropriate stop down there and wait until the trend is no longer a trend. Wait until your premise looks like it's no longer valid and then get out. I said you can buy for any reason. You can buy at the market. You can buy a bull breakout. You can buy a follow-through bar. You can buy more follow-through. You can buy with a limit order at the low of this bar, betting the reversal attempt will fail. You can buy with stops above these bars. Does not matter. But because the stop is far away, you have to trade small. And a strong bull trend has a high probability of continuing up. So the later you enter, the higher up you're being forced to buy. You always have to be thinking out your position size, and you have to adjust it based upon your stop. If you're thinking also that, hey, I'm going to buy this close, and if it drops all the way down here, I'm going to buy more, then you have to do the math and pick a position size that's small enough so that if you buy and buy more lower and get stopped out, you do not lose more than on any other trade. And then profit target. On a high probability trade, all you need is a reward equal to 1 times your actual risk. Your initial risk is here. But if you bought here, the market kept going up, your initial risk was just a tiny bit. Do you get out that tiny bit higher? No, because there's always a minimum. In a Forex market, you never want to take less than a 10 pip profit on a 5-minute chart. And in the E-mini, you never want to get out with less than a point. But again, when you have a 60% chance of a measured move up, I would not recommend scalping. Unless you're really good at getting back in, I would just buy and hold. In this video, I talked about the importance of follow-through after a breakout. If the follow-through bar is in the same direction as the breakout bar, higher probability the trend will continue at least a little bit. Because trends are always trying to reverse, traders will bet that the reversals will fail. So if you have a bull trend and then a bear bar, bulls will buy that bear close. If you have a bear trend and a bull bar, traders will sell that close. Finally, breakouts can be small. They can be as small as a single small bear bar or bull bar. And they can also be large. They can also be made up of many small bars. They come in many different types. I'm Al Brooks. Thank you for watching the Brooks Trading course. This is the second of 5 videos on breakouts. This is Al Brooks. Thank you for watching the Brooks Trading course. This is the third of 5 videos on breakouts. I'm going to be talking about one of the important characteristics of a strong breakout, and that is that there usually is at least a second leg. Sometimes there is more. Finally, I'll talk about trading range breakouts, successful trading range breakouts. Look at this chart. Here we have a series of bear bars. It's a bear flag. Odds are the breakout will be to the downside. So traders will sell below the low of the prior bar. They'll sell with a stop below that bar. They'll sell at the market, betting that the bull reversal attempt will fail. If you have a bear trend and then a small pullback like this, a bear flag, the probability is you get the bear breakout. So if you get a bull breakout, that's a surprise. It's a low probability event. And here we're getting the bull breakout. Traders expected the opposite. They expected a bear breakout, and instead they got a bull breakout. So traders are trapped in and out. Bears are trapped in. They've been selling here, betting on a second leg down. And bulls were trapped out. It was a low probability buy, so they did not buy above the highs of these bars. And look at the bull bodies. Small, smaller, non-existent. So they were not even buying closes. Yet we got the bull breakout. Bears are trapped into a bad trade. Bulls are trapped out of a good rally. Both are hoping for any kind of a pullback to buy. The bears want to pull back so they can buy back their losing shorts with a smaller loss. The bulls want a pullback because they see this as a surprise, a low probability event. They know there are trapped traders. They expect the market to go higher at least a little bit, so they're hoping for any kind of a pullback to buy. And because both bulls and bears are hoping for any kind of a pullback, if there is a pullback, both bulls and bears will buy it and we'll get a second leg up. A surprise means low probability. We're getting a bull breakout above a bear flag. And it's a pretty weak looking rally. So this is a pretty good bear flag. The odds were that the market was going to break to the downside. In any trade where one side has low probability, that side usually also has high risk reward. The bulls had a low probability bet that we'd get the bull breakout. Because it's a low probability bet, it has good risk reward. And that means either small risk or big reward. Big reward usually means at least a second leg up. Many bulls will not buy here. They'll wait until the market breaks above some kind of a major lower high. Like, for example, the high of that bar. And again, as I said, the bears were selling all of these bars, betting on a resumption of the bear trend. And they even sold early on in this bar, betting that it would be like these and the bulls would fail and we'd get a bear breakout. Some bears will even sell this close, betting that the bulls need one more bar, and chances are reversals fail and the bulls will not get their one more bar. So you'll get some bears not only selling as this bar formed, some will wait for the close and say, I got trapped bulls thinking that they're going to get a successful breakout. Therefore, I'm going to sell this strong bull close, betting that the bulls will not get good follow through. My risk is not big. I sell this close. I risk to just above this bar, and it's a reasonable trade. I'm risking very little. At this point, the probability is that the market is going higher, but some bears will take that short. Bull breakout. The bulls really need one more bar, maybe two more bars. We have a bear channel, and we get a bull breakout above the bear channel. We have a bear flag. We have a bull breakout above the bear flag. And now we have a major lower high. I say that. Let's just assume that we're in a bear trend. We pull back, and it's a major lower high, a strong breakout to a new low. And now we have a breakout above that major lower high. We have a pair of consecutive good bull bars. Some bulls will buy the close of this bar. Other bulls will buy on a stop above there. Bears will buy on a stop above here. Some bulls will say, well, it's consecutive bull bars, but only one bar is breaking above a major lower high. I need one more bull body. And as small as this bull body is, that is enough for traders to believe the probability is high that we're going to go up higher. So even though big tail on top, small bull body, it's a bull body and not a bear body. That is good follow through buying, and it increases the probability that the market will go higher. For some bulls, this is the breakout, a breakout of a bear channel and a bear flag. For other bulls, this is a more important breakout because it went above a major lower high. Some bulls will see this as the follow through from that breakout. Other bulls will see this as the follow through from this 2-bar breakout above this lower high. Both are high probability buys, and this is what happened. So first leg up and pullback, sideways pullback. We could not even pull back below the low of the prior bar. Traders were so eager to buy, both bulls and bears. Remember, bears are trapped into shorts, and at some point they conclude it's not going down, I got to buy. And the bears give up. And bulls are trapped out of longs, and they decide at some point that it's not going down, I better start buying with stops, maybe above the highs of these bars and this bar, or as this bar goes up above this bar, just buy. Traders decide that the price is wrong. No one wants to sell here, and it has to go up higher to find where there might be sellers. I call this a pullback. A pullback is any pause in a bull trend. Technically, this is a pullback. This bar fell below that bar's low, but this is a type of pullback as well. It's an II bull flag. We have a bull trend. We're always in long, and we went sideways in a pair of inside bars. It's a pullback. It's a bull flag. Look at the low of this bar. Traders saw this. They wanted to buy any pullback. They placed a limit order to buy at the low of this bar. Did not get filled. They placed a limit order to buy at the low of this bar. Did not get filled. So all of those traders who were so eager to buy a pullback are not getting into the market. Most of them are not getting filled with their limit orders. And at some point they say, it's going up. I'm just going to buy at the market. And you start to get that second leg up. So leg one, pullback, leg 2. After any kind of breakout with follow-through, the minimum goal is a second leg up. As I said, sometimes you get a third, fourth, or fifth leg up, but the minimum goal is a second leg up. We got a bull breakout, and now we're starting to form a channel. A tight channel like this is a breakout on a higher time frame chart. So this is still a strong bull trend. Yes, we have a second leg up, but it's probably continuing higher because a tight channel like this is usually a breakout on a higher time frame chart. So yes, 2 legs up, 1 pullback, 2 on a higher time frame chart. This is still part of leg 1, and we don't know where leg 1 ends. Whenever you do have a leg 1 move, you always think about, well, maybe we'll get a leg 1, leg 2 move. Maybe leg 1, pull back, and then leg 2, measured move up. Strong enough breakout here. First leg up, second leg up. Second leg up has strong breakout and decent follow through. So there may be a second leg up after this second leg up. In other words, a third leg up. So it's a strong enough breakout. More traders are trapped. Bulls are trapped out, bears are trapped in. Chances are we're going up at least a little bit more. Another strong breakout, probably strong enough for at least a second leg up. Breakout, pullback, second leg up. Sometimes breakouts are a single bar. Sometimes they're 2, 3, 4, 5, 10 bars. Sometimes you get one breakout and then a second leg up, and that's the end of it. You enter a trading range or even a bear trend. Sometimes you get a series of breakouts, breakout, pullback, breakout, pullback, breakout, 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 breakout. Now, sometimes you can get a very strong second leg. Here we have an okay bear breakout. Any trend bar is a breakout. Any series of trend bars is a breakout. Bars closing near their lows, having decent sized bodies, increase the probability that the first pullback will be sold and you get a second leg down. And sometimes the second leg down is very strong, especially if it's in a trading range, and it becomes a second leg trap. So if this were a trading range or a broad bull channel, and I see a strong second leg down like that, I'm assuming it's a second leg trap, and it's the end of the move, and not a measuring gap. So more likely an exhaustion gap, and the gap between this close and that low will close, and the market would either go sideways or even up. Strong bear breakout. Is it strong enough so that the odds are there'll be at least a second leg? Yes. Now, second leg does not necessarily mean second leg to a new low. Sometimes you get a breakout and the second leg does not fall below the low of the first leg. This might be the second leg, this might be the second leg, this might be the second leg. Sometimes the second leg down can form a higher low. Second leg down, it can be simply a single bar. Here we got a bull breakout of a bear flag. So we got either one leg up, pull back, 2 legs up, and we got a bull breakout above a double top. You can say 1 leg up, 2 legs up. So it could be a large bear flag. But in any case, we got a double top bear flag here, and we have a decent bull breakout, but look at the follow through. A terrible follow through bar. So you get disappointed bulls who bought that close, and now they're hoping for the market to get back to that close so they can sell out of their longs. And that's what they did here and here. A lot of bulls who bought this close or bought the breakout decided this is disappointing. I better get out break even. I'm going to place a limit order to sell on that close. And when it got back to the close, they sold. Strong enough bull breakout, the market's probably not going to go straight down. Strong enough bull breakout so that there will be some buyers on a reversal attempt and we'll get a second leg up. Again, sometimes the second leg up does not get above the top of the first leg up. And sometimes the second leg up is simply a single bar. Wedge bear flag, tried to get a bear breakout, and it reversed up and we got a bull breakout. Double top, instead of a downside breakout, we got a bull breakout. Second leg up, a problem. It's basically an II or an III pattern, micro double top, and this is a possible micro double top and a failed breakout. Higher probability to sell below this bar, betting on a failed bull breakout. The bulls tried to get up here, They had a second bar up here, and then this bar tells me that a lot of the bulls who bought here used this bar to get out break even, and the bulls are giving up. So we got a micro double top and a failed breakout above a wedge bear flag. Bulls will give up, and here the bulls did give up, and bears will short either below this bar, below these 3 bars, or below this bar. This is where traders mostly sold. Second leg, a lot of times it's not clear, and a lot of times you need to wait and you need more bars to get clarity. Different computers will use different counts. So strong bull breakout, pretty bad follow through, but still strong enough bull breakout for a second leg up. Is this the second leg up? Some computers will say this is it. We went sideways. We're trying to go up again. Is this the second leg up? Again, some computers will say that's the second leg up and we failed. Others will say this is the second leg up. Others will wait and say we'll probably get an even stronger second leg up. And here we did get an obvious second leg up. So at this point, maybe this is the second leg up. At this point, maybe it's the second leg up to a micro double top. Bears are trying to break to the downside. Bear breakout, bad follow through from these 2 bars. We got a clear second leg up. At this point, we have a big bull breakout bar, clearly a second leg up, comparable in strength to this, maybe leg 1, pullback leg 2, and then terrible follow through. The minimum requirement has been met. Strong enough to get a second leg up, we got a second leg up. Strong enough to get a measured move up, we got leg 1, pullback leg 2. So the bulls are satisfied, they got their goal. And then we got this bad follow through bar. A lot of traders will sell that, betting that we have the second leg up. Some traders will say, well, isn't this strong enough for another second leg up? It might be, but I certainly would not buy at the low of this bar. The only thing I would do at the low of this bar is either get out of longs or go short. Bear breakout. We have a bear breakout here, probably second leg down. This might be the second leg down. This is the euro versus the dollar 60-minute chart. Maybe this breakout is strong enough so that we get even further down. Maybe because this channel is so tight, I don't know if it's a micro channel, this might be a little pullback, but in any case, it's a pretty tight bear channel. It's a breakout on a higher time frame chart, so any pullback that we get probably will be followed by a second leg down. So strong bear breakout, 60% chance of a second leg down, 40% chance it'll fail and we will reverse up. Big bear bar, consecutive bear bars, the bulls are giving up. So all the bulls who were buying in here, hoping for a reversal, maybe higher low, major trend reversal, they gave up here. This is a minor reversal. You're getting the first breakout above a tight bear channel. Probably the best the bulls get is a bull leg that becomes a bear flag. Here, not enough bars for a major reversal. So again, minor reversal, which means odds are we're going lower. And here, both bulls and bears sold. The bulls sold out of their longs, giving up, and the bears sold, betting on resumption of the trend down. Same true here. Very strong bear breakout, possibly an exhaustive end of the move. Whenever you have a strong bear breakout occurring 20 or more bars into a trend, it's more likely to be an exhaustion gap, and that's what we have here. The biggest pair of bear bars in the entire sell-off occurring maybe 50 bars into the trend, more likely exhaustion gap. Gap between this close and this low, this close and that low, this close and that low. Chances are we're going to go to the top of the sell climax, or at least a little bit above it. And you get 2 legs up, 1, pull back, 2. But sell climax does not mean reversal into bull trend. It just means the bears are exhausted and they'll wait 5 or 10 or more bars before they're willing to sell again. They usually wait until the market tests the top of the sell climax. It tried to break above it here, 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 kept failing. And then at some point here, everyone sold. The bulls gave up and the bears sold. Another big sell climax, consecutive sell climaxes, here, 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 bigger, here, even bigger still. So probably we'll get some kind of significant bounce soon. Each one of these bear breakouts, bulls are giving up. The bulls who are hoping for a bottom, they're giving up. Bulls tried to bottom here, minor, tried to bottom here, minor, tried to bottom here, maybe a higher low, major trend reversal, major trend reversal, probably not enough buying pressure. So even this is probably a minor higher low. And every one of the reversal attempts failed. A lot of times when you're in a channel and the market becomes always in long, like it probably was somewhere in here, it's probably a broad bear channel. Broad bear channels typically have times within the channel that the market is always in long, but the market continues to make lower highs and lower lows. So here, this is a test of the top of this final bear leg, and it became a double top bear flag. Here's the neckline, broke below the neckline. Pretty impressive sell climax, probably an exhaustive sell climax. And we got to the top of the sell climax. And then here we have another even stronger sell climax, an even bigger bear bar than any of the bars in the past 100 bars. So the odds are it's going to be a sell climax, an exhaustion gap rather than a measuring gap. So it's possible that we get a measured move down from there. More likely the gap will close. By close, typically you get to the top of the sell climax bar, you get to the top of the sell climax leg, and then you enter a trading range. Sometimes you get a bull trend. Bull channel, bear flag. Bull channel or trading range, bear flag. Stronger bull channel, but still bear flag. Little triangle, bear flag. Got a bull breakout and then a bear breakout. Every attempt to rally, the bears see all of these attempts as bear flags. And so they're looking to sell a bear breakout below the bear flag. So they can sell with stops on the reversal back down. Some bears will sell above bull bars, betting that the reversal up is minor. But bears are selling all the way up, and that's why the rallies look so weak. Where are the consecutive big bull trend bars? They do not exist because the bulls are not strong enough, and all of these reversals are minor. Minor means, at best, a bull leg in a trading range, and the odds are that we'll have at least one more leg down. So I want to talk about breakouts in trading ranges and breakout attempts in trading ranges and successful breakouts in trading ranges. Clearly, a trading range. Everyone knows, I always talk about my 80% rule. 80% of the time, when the market's in a trading range, strong breakouts fail, or all breakouts fail, no matter how strong. So good bull breakout, reverse down. Good bull breakout, reverse down. Bears trying to break out, and they're failing. And after a trading range goes on for 20 or more bars, the probability of a bull breakout becomes the same as for a bear breakout. Before the trading range, we were in a bear trend, and early on, it was more likely we would get the downside breakout. But after 20 or more bars, the probability becomes about the same. Traders know that all through here, once you decide after 20 or so bars, it's a trading range, traders will bet against breakouts. They'll sell bull closes near the top. They'll buy bear closes near the bottom. They'll buy reversals up near the bottom. They'll sell reversals down near the top. And they scalp. They take quick profits because they know the odds are breakouts will not be successful. So they're scalping. Bulls and bears are buying low. Bears are buying low to buy back their shorts. Both are selling high. Bulls are selling high to sell out of their longs. But both know that because of the market cycle, the market's either in a trend or a trading range. And if it's in a trend, eventually it becomes a trading range. If it's in a trading range, eventually it becomes a trend. Trading range traders keep buying low, selling high, and scalping, knowing that eventually there'll be a successful breakout and they might lose. But if they take enough trades in here, profitable trades in here, they're hoping to make enough money so that it more than offsets the final losing trade. Bulls buy in the bottom third, scale in lower, scalp out. And bears sell in the top third, scale in higher, confident that the bull breakouts will fail. And eventually there is a successful breakout. But at this point, it's 50-50 bet. Will it be up or down? This is a pretty big bear bar. You can say, well, Al, it's a big bear bar and it's 60 or 70 bars into a trend. Isn't that an exhaustion bar instead of a measuring gap? Well, it's not really in a trend. The market was sideways for 30, 40, 50 bars. So this is probably the start of a bear trend. The bigger the bar is, the more likely the bears will get follow-through selling. The more it closes on its low, instead of having a big tail on the bottom, the more likely it'll lead to a leg down. And the more this close is below the trading range, the more likely will go down. And the more bars that this bar closes below, the more likely we're going to go down. So this has everything going for it. A big bar, closing on its low, closing below the trading range, closing far below the trading range, closing below the lows of the past 50 or 60 bars. So probably going to be some kind of a measuring gap. Bulls were buying low. They're also buying below bars. Below this bar, the bulls will buy. Below this bar, bulls will buy. Below this bar, bulls will buy. As soon as this bar closes, they place a limit order to buy that low, and they get this. But if you're a bull and you got long right here as the market fell below that low, what do? At this point, you know it's probably a measuring gap and that we're going lower. So you got to sell out of your longs. You can either do it immediately or you can wait for any kind of a pullback. But if you wait for a pullback and you're selling, you know the bears are going to sell as well. There are some bears who did not sell this breakout. It's a surprise. They're waiting for a pullback to sell. So both bulls and bears are waiting for a pullback to sell. What does that mean? It means that whenever this leg ends and we get a pullback, probably bulls and bears will sell the pullback and we'll get at least one more leg down. Okay, a pause. The bears, after their breakout, got their minimum, the absence of a bull bar. The bulls have a bull bar here, but chances are this is enough follow through this bar and that bar so that there are more sellers above this bull bar than there are buyers. Both bulls and bears will use this little reversal attempt to sell. Bears will sell into new shorts, the bears who did not yet sell, and bulls will sell to get out of their losing longs. It does not matter if you sold here or here. Your stop is still up here at the top of the bear leg. Maybe you can put it above the top of this sell climax or above the top of this. This is the start of where the market clearly became bearish. But in any case, you got to put a stop fairly far up. And what does that tell you? Risk reward probability, right? So your stop is far, so your risk is greater. Also, you're fairly far into the trend, so there's less reward. So selling anywhere in here has bad risk reward. When you have bad risk reward, you know you have good probability. So the probability is we're falling more. Let's say you sold anywhere in here and you say, gosh, my stop is way up there. I don't want to risk that much. And a lot of the computers that did short through here decide that the risk is too great. And when the risk is great, they have to reduce their risk. The easiest way is to take profits. And when the computers or traders take profits on profitable shorts, they get a little reversal attempt. This is not so much due to aggressive bulls buying as it is to bears looking at their stop being so far away that their risk is now big. It does not matter where you sold. If you sold here, if you sold here, if you're still short, that's your risk. So your entry price has nothing to do with it. All that matters is where your stop is. Wherever you entered, irrelevant. If you're still short down here, that's your risk. That's how much money you're risking. And a lot of bears will buy back some of their shorts, and it creates that little pullback. A lot of times, when there's a little pullback like that, the bears will wait a few bars to make sure the bulls do not get a micro double bottom and a big reversal. So a lot of times you go sideways for several bars after the profit taking, but the probability still is that the market will go lower. Let's say a bull does not buy back his long here. Maybe he's thinking, we should get higher up. We should overlap that low, maybe get up to the top of the sell climax. Some bulls want a higher pullback to exit with a smaller loss. So a lot of bulls will wait to sell out of their losing longs. And sometimes the bears will wait as well, thinking, Maybe this does not look like particularly good follow through, tight trading range. Maybe we will go up a little bit. Well, I'm going to wait a few bars before I sell because I'd like to sell higher, and I'll give it a few bars to see if it'll go higher. And if it does not, and instead it starts to go down, I'll sell the breakout, the downside breakout. Bears are giving a chance to the bulls. Okay, bulls, how strong can you be? Are you going to be able to turn the market up a little bit? And if you do, then I get to sell at a higher price. So you have bears wanting to sell and waiting to sell, waiting to see if they can get to sell higher. They're going to sell either way, but a lot of times after a little bit of profit taking like this, the bears wait to see if the bulls can lift the market higher, and then they sell. Bears see the bulls having a micro double bottom, but tight trading range. And is this the second leg down? Is it leg one, pullback, leg two? Or are traders still betting that this is going to be a measuring gap and that will fall for a measured move down? I think the probability still favors the bears. Bulls see a micro double bottom, hoping that we'll get a higher bounce. But a lot of the bulls will use any minor reversal like this to sell out of their lungs. And they'll give up, and we might get another breakout bar to the downside. The bears sell, knowing that the bulls will use any kind of a bounce to sell. Bears know that the bulls probably will wait many more bars before they buy again. If the market starts to go down after this attempt at a bottom, the bears know the bulls will probably wait 3, 4, 5, 6 bars before they buy again, so we can get vacuumed down pretty quickly, creating a very strong second leg down. And because of that, bears will sell, knowing that there are not enough bulls at this price. The market has to go lower to find a price where bulls will be willing to buy. So bears sell, and you get a breakout bar, a bear breakout. The bulls who bought in here are giving up. The bears who wanted to sell higher decided that it's not going higher, so they sold here. Trading range. This range might be too tight to trade, but if a person were trading it, they want to buy in the bottom third and sell in the top third. Bulls and bears. Bulls buy in the bottom third, hoping for a scalp up, and then they sell in the top third, take profits. Bears sell in the top third, hoping for a scalp down. When it gets to the bottom third, they buy to take profits. And both are willing to scale in. Everyone knows eventually there's going to be a successful breakout. After 20 or 30 bars in a trading range, the probability of a bull breakout is the same as the probability of a bear breakout. And they hope to make enough money scalping, especially with limit orders and scaling in during the trading range, so that when the breakout finally comes and they finally lose, they'll have enough winnings to more than offset that loss. Again, when a range is this tight, I think most traders should not trade. This is the dollar versus the yen. Bulls buy near the bottom, confident the bear breakout will fail. Bears sell near the top, confident the bull breakout will fail. And both are correct. 80% of all breakouts fail, so traders are willing to buy low, sell high, and scalp. Other traders, most traders when the range is this tight, most traders should wait for the breakout and see what it looks like. Early in the breakout, bears will sell the bull close at the top of the range, betting it will fail. But now we have a bull breakout closing on its high, closing above the top of the range, closing above the top of the past 50, 60, 70 bars. And then we have a follow-through bull bar. Tail on the top, yes, weakens the case for the bulls, but a close above the middle of the bar and a second close above the trading range. Probability is measuring gap, not exhaustion gap. So probably going up for at least a measured move based on the height of this range, so somewhere up here, and strong enough breakout so that if we try to reverse down, bulls and bears will buy. Bulls will buy, hoping to be buying low, expecting a second leg up. Bears will buy because they see a strong breakout with follow-through, knowing a second leg up is likely, so they'll buy back their shorts. A lot of bears wait for that follow-through bar here or here, and then conclude that this is just too strong. I'm going to buy at the market. And chances are we're going to get some kind of follow-through move up. This looks like buy the close, maybe starting here. Traders, every bull close, they just keep buying, betting that we're going higher for some kind of a measured move up. Every bar that gets added to it increases the profit target because one of the profit targets is simply based upon the breakout. From the open of the first bar of the breakout to the close of the final bar of the breakout, usually you get some kind of a measured move up. Now, suppose you bought below this bear bar, or above this bull bar, or even this close of this bar. Let's say you bought here. Where's your stop? For all of the traders, it's the same, below the bottom of the bull leg. Your stop has nothing to do with where you entered. It has only to do with the price action. And if you're buying on the bet that it's a swing up, it does not matter where you bought. All that matters is where the stop goes, below the bottom of the most recent higher low, so down here. At some point, traders start to get uncomfortable. They say, well, gosh, my stop is way down there. I don't want to risk that much. And the computers have protective algorithms within them. So whenever the stop gets too far, they conclude the risk is too big. They have to control the risk. Easiest way to control risk is take profits. And that's why you get a pullback. Even though it's a very strong bull trend, you still get a pullback. Because at some point, too many traders, too many computers decide they have to take some profits to reduce their position size. So that profit taking creates the pullback. But it's still a bull flag. The bears who sold for any reason are hoping for a deeper pullback if they did not give up here. Most did give up here, but if they did not, they're hoping for a deeper pullback that would allow them to exit with a smaller loss. Some bears selling up here, and they need a deeper pullback to make a profit. So bears are looking to buy. And when you get a pullback like this, a lot of times the bulls will wait 5 or 10 bars to see how low the bears can drive the market. The bulls want to buy. They'd like to buy down here, but they'll buy for any reason. And if the bears are not successful in lowering the price after about 5 or 10 bars, the bulls will just buy at the market, or they'll buy above bars with a stop, betting on a second leg up. And if the bears are not successful, all the bears who shorted in here and the bears who shorted down here and who did not get out here will give up, and that will create a second leg up. If this grows to 20 or 30 bars, then we're back in another trading range. After about 10 bars or so, bears start to buy, getting nervous that it's not going down, and they got to take their loss. And bulls begin to buy as well. Same reason. It's not going down. Odds are we're going up with some kind of a measured move. And after 5 or 10 bars, if it's not going down, I want to buy. So I'll start buying with stops or at the market. And then we got a little bit more by the close after 3, 4, 5 bull bars. Reversal attempts probably fail. Pretty tight bull channel, not much in terms of big bear bars. So more likely these reversal attempts will fail and will continue higher. The bulls know the bears are trapped. So when it starts to go up, even though the bars are small, once you start to get 3 or 4 bull bars, the bulls know the bears will give up. So the bulls are buying, and the bears eventually do give up. Maybe that bull trend bar there. In this video, I talked about the importance of a strong breakout, because if it's strong enough, the odds are the first pullback will be followed by a second leg. And then next, I talked about successful trading range breakouts. I'm Al Brooks, and thank you for watching the Brooks Trading Course. This is the third of 5 videos on breakouts. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 7 videos on breakouts. In this video, I'm going to talk about second leg traps. The market makes a leg, has a pullback, and then has a second leg. The second leg is especially strong, leading you to think that it's going to lead to a breakout, yet it reverses. I'm going to also talk about strong breakouts. I will discuss whether or not breakouts are likely to succeed or reverse. Even when something seems very clear, you always have to be ready for a surprise. Nothing in the market is 100%, and most things are only between 40 and 60% certain. So that means even when you think something is probably going to happen, there's at least a 40% chance the opposite will happen, or what you think will happen will not happen. For example, here we have a pretty good bull trend, and then a pullback that's not very strong. It lacks consecutive big trend bars closing on their lows. Also, it pulled back about 50% of the bull trend. So the odds are it's a bull flag, and it will be followed by a second leg up in a test of the high, or certainly of the high close. Both bulls and bears expect a rally. The bulls got a breakout, a decent looking bull trend bar closing on its high, and closing above the high of the past 5 or 6 bars, so that is a sign of strength. And at this moment, there is a 60% chance that we're going to go at least a little bit higher. Yet, you always have to be prepared for a surprise. Here, we have a huge bear trend bar closing on its low, closing below the low of the prior bar, closing below the higher low, closing below the low of the past 20 bars. So that is a big surprise. Huge bear breakout, but you need follow through. And instead, look what the bulls did. They created a bull trend bar after a huge bear trend bar. And that generates confusion. Why were the bears unable to get a second consecutive bear trend bar? And why were they unable to close this bar below the low of the bull leg? So something's wrong with this bear breakout. We have a bear breakout and a pullback. So this is a low one sell signal bar. It did not get triggered. We have another pullback bar. And the follow through from this bear breakout came 2 bars later, not on the next bar. It's always better if you get immediate follow through and the second bar is a big bear bar closing on its low. It's usually a lower probability bet that the breakout will be successful if the bar after the big bear breakout is a bull bar. But sometimes you get the follow through bar 2 or even 3 bars later. Here we have a bear bar closing on its low, and it's a low one sell signal bar. The high of the bar stayed below the low of this higher low, so we have a gap. That also increases the chances that we're going at least a little bit lower. Now think about what just happened here. We have a huge bear bar closing on its low, surprising everyone. Whenever there's a surprise, bulls and bears both get trapped. Bears get trapped out. They thought the market was going up, and a lot of bears did not sell here. They're hoping for any kind of a pullback that will let them sell at a higher price. Bulls also assumed the market was going up, and as this bar started to form, they assumed it would form a double bottom here. Yet when it closed way down here. And the bulls at this point, who did not get out during here, are thinking, oh my gosh, I'm in a losing position, I got to get out. And they're hoping for any kind of a pullback to get out with a smaller loss. So a lot of these bulls who bought anywhere in here, bought this breakout of a bull flag and did not exit here, now have limit orders trying to get out, maybe at a 50% pullback from this bear breakout. Maybe they'll sell above this bull bar, maybe they'll sell below this bear bar, but these bulls are trapped into a losing trade. So bulls trapped in, bears trapped out. The market's probably going to go down for at least a small second leg, maybe for a big bear trend. Here, we did get a second leg down. Both bulls and bears sold below this pullback bar, so it's a low one short, first pullback. The bulls tried to reverse up again a second time from a micro double bottom, but are these 2 bull bars enough to reverse that bear bar? Probably not. So a lot of traders would not buy above this bull bar. And the bulls who did saw the entry bar is a small bear doji. They are unhappy, and those bulls are going to get out. And the bears are happy that this is not a big bull bar, that it's a bear bar. So they're more confident that we're going lower. Some bears sold the low one, and other bears sold the low 2. The low 2 bears have a good entry bar, good follow through, probably going at least a little bit lower. I want to talk a little bit about second leg traps. Here, we're in a trending range. We're down, we're up, we're down, we're up. And even though the market's rallying here, big bull bar, doji, big bull bar, doji. It's selling off here. We've got a couple bear bars and then bad follow through. Tails below bars. tails above bars. This is trading range price action. So even though we're selling off, it's probably a bear leg in a trading range. Even though we're rallying, it's probably a bull leg in the trading range. And then you get this. What just happened here? We have a huge bull breakout at the start of a second leg up. Yet, it's not above the top of the trading range. You look to the left. We're a little bit above here, but what kind of follow through did we get? We have terrible follow through after the bull breakout above the top of the range. In trading ranges, there's often a very strong second leg. First leg up, pullback, second leg. But unless there's both a strong breakout and strong follow through above the top of the range, it's more likely a second leg trap. So first leg, pullback, second leg, trapping traders into believing the breakout will be successful. Yet it traps bulls into buying high. Here we have a sell-off, not particularly strong, lacking consecutive big bear trend bars, bad follow-through after bear bars, big bear bar tail on the bottom. It looks like a leg in a trading range. And then we're accelerating downward, and here we have a pair of strong bear bars closing on their lows, not big tails. So this looks like the market is changing from trading range price action into breakout trend price action. However, whenever you have a breakout of a trading range, you always have to be suspicious that it could be a second leg trap. And that's what took place here. So first leg down, pullback, and now we're trying to accelerate into a trend. Yet it was a trap. It trapped traders into selling low. We have a micro double bottom, a good looking bull bar, and then we begin a leg up in the trading range. Here, strong leg up, second leg. First leg up, a leg in a trading range, a pullback, a bull flag. The bulls are hoping it's a bull flag, and this is the start of a bull trend. And then we have this very strong second leg up. And bulls are hopeful. They're hopeful that the breakout will succeed. And traders who do not understand what's going on, they'll buy. And then they'll hold long even after this big bear bar. Smart traders will say, second leg trap, trading range, I'm going to start selling below this strong bear bar. Trading ranges, they constantly trap traders into buying high and selling low. You constantly get strong breakouts near the bottom that fail, trap traders into selling low, strong breakouts near the top that fail and trap traders into buying high, and they reverse down. Usually, when they reverse down, you get a good sell signal bar. When you have a second leg trap at the bottom and they reverse up, you get a pretty good looking buy signal bar, and very often a micro double bottom. It's very important always to look to the left. Bear breakout, look to the left. Wait a minute, there's a lot of trading range price action here. This might be a trap. Very strong bull breakout, look to the left. We only have 1 or 2 bars above this close, and then we get this reversal. This might be a second leg trap. We have a trading range, and most trading range breakouts fail. Whenever you get a breakout, a second leg that looks strong enough so that a third leg down is likely, yet you're in a trading range, you have to be ready for the possibility that the breakout will fail and the trading range will continue. No matter how strong the breakout is, whenever there's a trading range breakout and you get a breakout that looks like it's strong enough to be the start of a bull trend, at least get a second leg up, you have to be prepared that it's a trap, forcing traders into buying high and then immediately reversing. If you see the breakout not having good follow-through buying, and instead you get a bear bar closing on its low, this is probably a trap, and we're probably going to get a couple legs down, 1 pullback, 2. I'm going to talk a little bit now about signs of strong breakouts, things that make traders believe that a breakout will be successful. All right, be ready. These are signs that a bull breakout will be strong. My list is not complete, but the point I'm making is that there are lots of indications that a breakout will be successful. And the more of these things that are present in a breakout, the more likely the breakout will succeed. You can stop the slide here and you can read them. I'm not going to spend a lot of time on this slide because if I did, I would have to spend a lot of time on this slide. This is a list of signs that a breakout will be weak. It's pretty much the opposite of those on the prior slide. This is for a bull breakout. Here, a bear breakout. The more of these things that are present, the more likely the bear breakout will succeed. So these are signs of a strong bear breakout. And here is an opposite list. The more of these things that are present, the more likely the bear breakout is weak and it will fail and reverse. I just gave that long list of signs of strong and weak breakouts for both bull and bear trends. I'm now going to be talking about whether or not a breakout will succeed or whether it will reverse. Although it might be hard to believe, this is the single most important concept in trading. Will a breakout succeed or fail? The market is constantly probing. Is the price too low? Is the price too high? So it's constantly trying to break out. And the breakouts succeed, the breakouts fail. Here we broke out, we went down further. Here we tried to break out, but we reversed up. Here we broke to the upside, reversed down. The market's constantly probing to find the appropriate price. Where is the right price? What price is too high? What price is too low? This is the basis for everything that we do as traders. Do we want to enter the trade? Do we want to bet on an opposite trade? Where are we going to put our stop? If we got a breakout that failed to the downside and we reversed up strongly, our stop is going to be down here. Where are we going to take profits? Well, maybe we'll take profits near the top of the bear breakout. It's the basis of everything that we do as traders. We have a bear breakout. We got follow-through selling. We have another bear breakout, big tails, and then we have a bull doji bar here. This is a triangle, 3 pushes down, 1, 2, 3. And we have a bear breakout. A triangle late in a bear trend usually becomes the final bear flag, and the breakout usually does not go very far before there's a reversal, at least back to the apex or middle of the triangle. Here we have a bear breakout. It failed. We reversed up in a series of bull bars or doji bars, the absence of bear bars. The failed bear breakout was followed by a successful bull breakout. Every bull close, this close was at the close of this bar. This close above the close of this bar. Every close is at or above the close of the prior bar. A bull bar closing on its high, and then a pair of very big bull bars closing on their highs. This is where the bears finally gave up, and traders decided that we're now in a successful breakout. I think it's important to realize that every trend eventually ends with some kind of a failed breakout. Remember, every trend bar is a breakout of something, and every trend fails sooner or later. And every tail is a failed breakout. The market tried to go one way, and it reversed before the bar finished. Here we have a bear breakout, bear trend, a pullback, an attempt to reverse up, so it's a bear flag, and we broke out. We broke to a new low, but look at this, we reversed up. So the breakout to a new low failed. And now we have a double bottom, a slightly lower low double bottom, but a double bottom. This bull doji is probably not strong enough to reverse these two bear bars. This reversal is probably minor, and therefore a leg in a bear flag or in a trading range, and the market probably will continue sideways to down. This bull bar, a trend bar, every bull trend bar is a bull breakout. It's a breakout above this double bottom, or at least above this buy signal bar at the double bottom. Another new low, another breakout, and a big tail on the bottom. At one point when this bar was forming, it was a big bear trend bar, big bear black bar, like it looked like this. But when it closed, it was this, a small bull body, and a close above the breakout point. So it was a breakout, but it failed. Whenever you see a failed breakout, you have to be thinking, is the failure going to lead to an opposite trend, like this, or is it simply going to lead to a pullback, a bull flag, and the trend will then resume? Here, we have a failed bull breakout. At one point, this was a bull bar, but it closed on its low, and now it's a bear bar. It's setting up the possibility of a reversal of this bull breakout. So this bull breakout is now failing. So bull breakout, a bear bar closing on its low. This could be the start of a bear trend. Here, we have a bull breakout with a tail on top. This bar traded below its low. The bears are trying to reverse the bull trend. They obviously did a bad job, but this pullback, this low going below that bar, is an attempt to reverse the bull trend. So at this moment, when this bar traded below that bar, it was a failed bull breakout. When this bar traded below the low of this bar, it was a failed bull breakout. So bull breakout and then a reversal. Bull breakout and then a reversal. These reversals, however, became bull flags. They led to trend resumption up. So reversal attempt, but it reversed into a minor reversal, a bull flag. Failed bull breakout, a reversal attempt, again, minor reversal, became a small bull flag, and the bull trend continued higher. Look at this one up here. Take a look up here. Failed bull breakout, and this time, instead of leading to a bull flag, it tried to be a bull flag here. In fact, it led to a trend reversal. So here we have failed bull breakouts creating bull flags. Here we have a failed bull breakout creating a trend reversal. Traders are constantly trying to determine whether a breakout will succeed or reverse. Because if you can create a trade with a mathematical advantage. You can create a trade with a favorable trader's equation. You have an edge. Think about this for a second. Bull bar closing on its high, bull bar closing above its midpoint, tail, yes, but still a bull bar. Same with this, tail, yes, but a bull bar. We have 3 consecutive bull bars all closing above their midpoints, 2 very big bars. This open is above the close of this bar. So as soon as this bar closed, traders hit buy the market. They didn't place a limit order, they just said buy the market. This open is above the close of that bar. Again, a lot of urgency. Bulls are very eager to buy. Do you think this reversal is going to be a bull flag or a bear trend? Well, the first pullback after a strong bull breakout, high probability there'll be at least a small second leg up. If the breakout's strong enough, there's probably going to be a measured move up, maybe from the open of the first bar of the breakout to the close of the final strong bar of the breakout and measured move up, which is what we got here. Since the probability is high that this failed breakout will fail, in other words, the attempt by the bears to reverse the market will fail, and this will become a bull flag, traders will look to buy. They'll place a buy stop just above the high of this pullback bar, or they may want to buy above a bull bar, so they may buy above the high of this bull bar and enter right there. Strong bull breakout, pullback, breakout, pullback, breakout, so a spike in channel, wedge, breakout, pullback, second push, pullback, third push, very common pattern, and it very often tests down to the bottom of the channel. So spike, pullback, channel, and traders look for a reversal down to test the bottom of the channel, and then usually it ends up in a trading range. In any case, if you're long, you probably will get out below this strong bear bar, given that it's a wedge top, and given that we're probably coming down here. And if you're not long, but you're a fairly aggressive bear, you'll sell on a stop right below the low of that bar. You'll sell the reversal down, hoping that will test down to the bottom of the bull channel. Now, clearly a strong bull breakout. As I said, opening above the close of the prior bar, big bull bars closing on their highs, consecutive bull bars, 2, 3 consecutive bull bars. How do you get long during a strong breakout like this? Well, there are lots of ways to get long. Many traders will simply buy at the market. As the market's going up, they just hit the button, buy. They just buy at the market. Other traders will wait for bars to close, and then they'll buy at the market. They'll wait for the close of a bull bar, they'll buy at the market. And they'll even buy the close of a strong bear bar betting that the reversal will fail. A lot of traders are happy to buy the close of consecutive bear bars as long as they're not too big. If these two bear bars are closing down here, they will not buy. But if the bear bars are small compared to the bull bars, they'll buy, because a lot of times traders will think, it probably has to have 3 or 4 consecutive bear bars to really reverse this strong bull breakout. And therefore, if it has 2, it does not have 3. It probably will not get 3. Therefore, I'll buy the close of 2, betting that it'll not get 3. So traders will buy the close of bull bars and the close of bear bars. They'll both buy below bars and above bars. They'll buy below bars, betting that the reversal attempt will fail, so that the bears who sell below that bar will lose money. Bulls buy that. They'll buy exactly what the bears are selling, betting that the bears will lose. And then they'll buy above a bar because they believe the bears who did sell will give up. The bears will say, uh-oh, I made a bad trade. I got to buy back my shorts. So they'll buy above the high of the prior bar. Others will buy above the high of a bull bar. Some will simply buy simply because it's a bull flag. It's a minor reversal down. So some traders buy the reversal up, betting that the reversal down is simply creating a bull flag. They're buying pullbacks or reversals up from pullbacks. Whenever you see a strong bull breakout, you have to be ready for a bull flag, and you have to be ready for the bull flag to break to the upside. You place a buy stop just above the high of the prior bar, hoping that if the market resumes up, you'll place a buy stop at the high of the prior bar. When this bar closed, you had bulls placing a buy stop above its high in case the market went straight up. Then we have a pullback bar, low below the low of the prior bar. Bulls now lowered their stop from above this bar to above this bar, and they got filled over here. So you have to be prepared for the resumption of the trend back up. Strong bear trend. We have a bull breakout, but 2 bear bars, 3 bear bars, close below the low of the past 7 or 8 bars. The bear bar getting bigger. In a bear trend, different ways to get in. One is simply sell at the market. At some point, as this bar is falling, you have to conclude the bulls are trapped. They have to get out. This bar is falling very fast, and it's because we fell below the bottom of this bull breakout. And a lot of the bulls are deciding that they're on the wrong side of the market. And the bears see that as well. They assume that maybe we'll fall for a measured move down based upon the height of this bull breakout. That would be somewhere down here. They know we're going lower. So a lot of traders, if they're quick to understand what's going on, that this is a reversal, a failed bull breakout, they'll simply hit the button, sell at the market. Other traders prefer to sell the closes of bars. They'll sell the close of a bear bar, betting that we're going lower. And whenever they see a bull bar closing near its high, they'll sell that as well, betting that the bull reversal attempt will fail, become a bear flag, and lead to a trend down. These bull bars, we have 3 bull bars here, but the bull bars are not big, certainly not big relative to this. The bears will sell the bull closes, betting that this is a minor reversal and that the bear trend will resume down. Traders will also sell above the high of the prior bar, and they'll sell below bars, betting that if the market falls below the low of the prior bar, the bear trend probably is starting to reverse down. Bear flag, so they place a stop to go short just below the low of the prior bar, betting that the breakout of the bear flag will be a resumption of the bear trend. Bear flag, it's a bull channel, and we're breaking below the bottom of that bull channel, bear flag, and the bears bet that the trend will resume down. Weak rally, minor reversal, probable bear flag, worst case probably a trading range. If a rally looks weak, you have to assume it's a bear flag, and traders have to be prepared to go short. When this bar closed, traders placed a stop order to go short below its low, not filled. When this bar closed, traders placed a stop order to go short just below its low, not filled. And the same with this bar, and this bar. And here, they did get filled, finally. But that's traders who are prepared to go short. You have to be thinking about it, and you have to be placing your orders. You have to be ready to catch the trade. In this video, I talked about the second leg traps, where the market makes one leg, pulls back, and then has an even stronger second leg. But the second leg leads to a reversal instead of a measured move. It traps traders into buying high if it's a strong second leg up. It also traps traders into selling low if it's a strong second leg down. Second leg traps are common in broad channels and especially common in trading ranges. I also talked about signs of strong breakouts. I then talked about characteristics of breakouts that lead traders to believe the breakout will be successful or that it will reverse. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 7 videos on breakouts. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 7 videos on breakouts. When there is a big breakout late in a trend, it typically results in either an exhaustion move, in other words, the end of the move, or a measuring gap, the midpoint of a move. Next, I'll talk about how weaker breakouts typically have deeper pullbacks and an increased chance of a channel or a trading range. I talked about big trend bars and breakouts, and sometimes they can lead to a measured move up, a big continuation of the trend. Other times they can be a sign of an exhausted trend, and they could lead to a reversal. So is a big trend bar an exhaustion gap or a measuring gap? Here we're either in a trading range or a bull trend, and then we see this, a very big bear trend bar closing on its low, closing below the low of the past 10 bars or so. Is this more likely exhausted bears who are tired from selling, or is it the start of a bear trend and more likely a measuring gap, a gap between this close, that low, a gap between this close, that low, a gap between this close, that low? It's a strong breakout. The context is good. We have trapped bulls who thought we were going to get a successful bull breakout, and we have a very strong reversal. 3 consecutive bear bars closing on their lows or near their lows, and now we have an even bigger bear bar closing below the lows of all of these bars. Chances are bulls are trapped into a losing trade, and many bears have not sold yet, and they're trapped out. The odds are this gap is going to lead to a measured move down, maybe from the height of the buy climax to the bottom of the buy climax, and then a measured move down. This big bear trend bar is a sign that the bulls are giving up. It's a give up bar, and it's a strong bear breakout. It's probably a measuring gap. The top of the buy climax, the bottom of the buy climax, the bulls are hoping for a double bottom. Even though there's no obvious attempt at a double bottom, whenever I see a strong bull breakout and then a reversal below the low of that bull breakout, I think of it as a failed double bottom. And if it broke above the neckline, let's say we bounced here and formed a double bottom, this would be the neckline. Traders would look for a measured move up. And if instead it breaks below the bottom of the double bottom, traders will look for a measured move down, which is what we got. This is early in a trend. Suppose you get a strong breakout late in a trend. Well, the chance becomes greater that the big breakout is a climax and that it will lead to the end of the trend or even a reversal. Here we got a big bull trend bar. We don't know how late in the trend it is, but it's certainly about 7 or 8 bars in the trend. If it was 20 or 30 bars in the trend, and you see the strongest bull bar, the biggest bull body, coming late in the trend, it's usually more likely an exhaustion gap, a gap between the close of this bar, the close of the prior bar, the close of this bar, and the swing high over here. That gap will probably close, which it did right here. The low of this bar closed the gap above this bar. The low of this bar fell below this high, and it closed that gap as well. It's therefore an exhaustion gap. And exhaustion gaps mean that the bulls are tired, they're exhausted. That doesn't mean the market will turn into a bear trend. In fact, most of the time when you have an exhaustion gap, the market goes sideways. But if the context is good, and if you start to get consecutive big bear bars, the odds are you're going to get a reversal and not simply a pause in the bull trend. Look at this bar. What do you see? The biggest bull bar occurring 20 or more bars into a bull trend. Whenever that's the case, you have to be wondering, is this more likely the start of a new leg up or more likely an exhaustive end of the bull trend, an exhaustion gap? Whenever I see the biggest bull trend bar coming 20 or more bars into a bull trend, I believe it's more likely an exhaustive move instead of an acceleration into a new, even stronger bull trend. At this point, you're wondering, okay, this low did not fall below that high, so maybe it is a measuring gap. Maybe we get a measured move up from this low to this high, which is the bottom of this gap. Or is it more likely big bull breakout and then bear reversal bar, increasing the chances that it's an exhaustion gap? When I see this, as soon as I see a big bull bar late in a bull trend, I assume the odds are it's an exhaustion gap, a buy climax. And then if I see it followed by a big bear bar closing on its low, the odds are high, 60% or more, that the gap will close. That will fall below the high of the prior bars and close the gap. Here we have an attempt to reverse up into a bull trend, and then we have an attempt to resume the bear trend down. It's a big bear bar closing on its low. Is it more likely an exhaustive end of this sell-off, or is it more likely a breakout below a double top leading to a measured move down? Look at the next bar, a bull bar closing on its high. Terrible follow through. At this point, you got to be thinking, we got a bear trend, a strong bull breakout, and a pullback that's reversing back up. This is probably a higher low major trend reversal. We have a double bottom bull flag, broke to the downside, reversed up. Probably a failed wedge bottom. First leg down, second leg down, third leg down. Whenever you have a double bottom that breaks to the downside and then reverses up, it's effectively a type of wedge. So that also is in favor of the bulls. This big bear trend bar closing on its low and below the low of this group of 7 or 8 or 10 bars, probably an exhaustion gap, probably a failed bear breakout. Here we're in a broad bull channel. We have a high, higher low, higher highs, higher lows, and now the trend is accelerating upward. We have 3 consecutive bull trend bars, the strongest series of bull trend bars occurring maybe 40 or 50 bars into the trend. Yet, look to the left. We're still not above all of the bars. So you have to be thinking that this is possibly a second leg trap, a strong bull trend occurring as a second leg. First leg up is a weak bull channel, a broad bull channel with lots of two-sided trading. And now we're accelerating upward. And we have the strongest series of 3 bull trend bars, and we have the biggest bull trend bar occurring more than 20 bars into a trend. And you look to the left, we're not above anything. We're still in the trading range. This is more likely going to be an exhaustive end of this trend than the start of an even stronger bull trend. So it's more likely an exhaustive buy climax than it is a measuring gap. Here we have a micro double top. The bulls tried to reverse up. Does this look like a strong reversal up? No. Where are the consecutive big bull trend bars closing on their highs? This looks like a bull leg in a trading range. And now we have a double top. It's still bullish at this point. Probably we're going to try to go higher. But once you see this big bear bar is reversing that big bull bar. We have a reversal up, down. This is probably going to end up as an exhaustion gap. And this is a sign of bulls giving up. We're probably going to get at least a second leg down. That second leg will probably close the gap. Then this becomes an exhaustion gap. And maybe the entire 3 bull bars becomes an exhaustion gap. Here we have a trend up and then a trend down. And every trend bar is a breakout. Here we have a breakout and it led to higher prices. Here we have a bear breakout, and we got lower prices. Bull breakout, higher prices. This is looking pretty good for the bears. We have a bear bar closing on its low, and we have a second bear bar closing on its low. This looks like decent follow-through and possibly a measuring gap. The high of this bar did not get above the low of that bar, and therefore this is potentially a measuring gap. But then the next bar, bull bar closing on its high, and then we close the gap. By this bar going above that low, we've closed the gap, and this is therefore a failed bear breakout and an exhaustion gap. Here, the biggest bull trend bar, more than 20 bars into a bull trend. Is it more likely the start of an even stronger bull trend, or is it more likely an exhaustion gap? At this point, we pulled back for a couple of bear bars and got a good bull reversal bar. We still have an open gap between this low and this high, so this still could be a measuring gap. Even though we fell below these highs, we still held above this high, so it's still a possible measuring gap. However, whenever I see the biggest bull trend bar occurring 20 or more bars into a bull trend, the odds are it's going to be an exhaustion gap. Here, a doji bar, not a strong sell bar, but here we have a bear bar closing on its low. That makes me think that the odds are this will end up as an exhaustive end of the trend instead of the start of an even stronger trend. Remember, most buy climaxes do not lead to bear trends. They usually lead to a trading range. We have big up, big down. Big up, big down means big confusion. Confusion is a hallmark of a trading range. So most buy climaxes, most sell climaxes are followed by trading ranges, not necessarily reversals. Here we have a big bear trend bar, and to me it looks like the bulls are giving up. They have a rally that lacks consecutive big bull trend bars, a lot of prominent tails, and a possible double top. So we have a double top after a buy climax. Here, a big bear bar. This looks like the bulls are giving up, the bears are getting aggressive. It could be the start of a spike and channel down. Spike, pullback, channel. In fact, spike, pullback, protracted channel. Whenever I see a buy climax that's starting to reverse, I always think the first target is just below the low of the buy climax bar. The bulls try to get a double bottom there. They tried, failed. And the bears want a strong breakout below that double bottom, and then they want a failed double bottom and measured move down. So we're trying to get a double bottom. The bulls want to break out above the neckline, which is the highest point in between. So they want a measured move way up off the top of the screen. And the bears want the double bottom to fail, and they then want a measured move down based upon the height of the double bottom. The neckline of the double bottom, the bottom of the double bottom, the bears want the measured move down. In any case, whenever you have what is probably going to be an exhaustive buy climax, the first target is the bottom of the buy climax bar, and the bears who sold up here take partial profits, and that's why we reversed up. Aggressive bull scalpers buy there, betting that we'll get at least a high enough bounce for a profitable scalp. I think it's important to be aware of context and price action. Here we have a bull bar, a bigger bull bar, a bigger bull bar. So should you be scalping here, or should you be thinking that, this might be the start of a bull trend? And if it's the start of a bull trend, do you want to be scalping or swinging? Usually when you get a very strong bull breakout with good context, it's going to lead to some kind of a measured move up. The first thought I always have is the open of the first bar of the strong breakout to the close of the final bar of the strong breakout, leading to a measured move up. This is the final bar of the strong breakout. We have another bull bar and another one here, but this one has that big tail on the top of the bar. This is, to me, the end of the very strong breakout. In any case, traders have to be confident, 60% or more, that the market is going higher, and therefore it's better to be swinging at least part of your position. The bears are giving up. Through here, there's trading taking place, which means bulls are buying and bears are selling. And as the bears see this start to go up, more and more bears give up. The market is always in long. The odds are we're going higher. buying has a strong trader's equation. A successful breakout means that the bulls have a successful, profitable trade. The trader is satisfied. Bears are giving up, bulls are making money. We have a bear breakout here, and it's a strong breakout, and the context is good. Here we had a lot of trading range price action, maybe a higher low in an attempt to resume this rally, so leg one pullback, maybe leg two. Instead, we got a big surprise, a pair of consecutive bear bars, big bear bars closing on their lows. At a minimum, they'll probably lead to at least a measured move down from the open of the first bar to the close of the second bar, so a minimum target is down here. Traders are confident that the market is going lower. Traders should be swinging at least part of their trade. The bulls are giving up. The bulls are hoping for a higher low and a second leg up. First leg pullback, second leg. Instead, they gave up, and they're quickly selling. The bears are selling as well. Everyone sees that the momentum down is very strong, and the market has changed. So instead of a possible bull flag, we have a very strong bear breakout. It's probably the start of a bear trend. Selling, a very strong trader's equation. And a successful breakout simply means that traders who shorted made money. The traders are satisfied. So we have a strong bear breakout, and it was successful. We went lower. Successful because the bears who sold made money. When the market's in a strong breakout, the pullbacks are usually small. When the market is in a weaker breakout, the pullbacks can be deep, and the market can look much more like a trading range. Take a look at this. We have a breakout, but a tail close at that low instead of below the bar. We have consecutive bear bars, again, big tail. Does this look like a strong bear breakout, or does it look like a weak bear breakout? It looks weak. We have a lot of overlap, the high of this bar, the close of this bar, the high of this bar, the lows of the past three bars. The bars are not particularly big. The bear bodies are getting smaller, here, here. That generates confusion. Traders are wondering, is this really the start of a bear trend, or is it more likely a bear leg in what will end up as a trading range? Consecutive bear bars, but prominent tails, and the bodies are small. And because the bear breakout is weak, there's less certainty, less conviction on the part of the bears. A lot of the bears don't want to sell at the low. They only want to sell higher. Bulls see the weakness, and they'll buy below bars. They'll buy bear closes, betting that the bears will not get consecutive closes. They'll buy reversals up, betting that this is probably a bear leg in what will become a trading range. We're rallying here, but what do you see? Big bull bar, but followed by only a bull doji, and then by a bear bar. Another bull bar, but smaller than the first. Was it followed by a doji? And we did not break above the top of the sell climax. We're breaking out to the upside, but look, weak rally, bad follow through, breakout, bad follow through, and lower high. So possible double top bear flag, possible bull leg in a trading range. Traders will see that, and bulls will take profits, and bears will start to sell. So it's either a bull leg in a trading range, or we have a lower high. It could be a bull leg in a broad bear channel. Here we have a bull breakout here, another bull breakout here, prominent tails, the absence of consecutive big bull bars closing on their highs, and we're still below the top of the bear breakout. This looks like a bull leg in either a trading range or in a bear flag. We're trying to get a second leg up, decent bull bar, but look at this, the follow through, a pair of dojis, and then another bull breakout, but big tail followed by a bear bar. This looks like a weak breakout, probably a bull leg in a trading range or in a bear flag. Weak bull breakout. We have a bear channel, bull breakout. You have to assume pullbacks will be deep and last a lot of bars. Weak bull breakout. You have to assume the pullbacks will be deep or last a lot of bars. So possible trading range. Here we're in a broad bull channel, high or low, but let's take a look at the bear breakout and the bull breakout. We're selling off. We have a double top, slightly lower high double top, neckline. We broke below the neckline, but look at the breakout bar, a bull bar. And look at the sell-off. We have consecutive bear bars, but not particularly big. We have a big bear bar here, but then a bull bar. We have consecutive bear bars here, but then a big bull bar. Here, same thing. A pair of bear bars, not very big. A pair of bear bars. This one's big, but did not close below the neckline of this double top. And it was followed by a bull bar. Whenever I see a bear breakout that does not look very strong, I assume there'll be a deep pullback, or at least a pullback with a lot of bars. Bear breakout, not very strong. Here we got a pullback that was at least 50% up. Big bear breakout, and expect a deep pullback. It's either a bear leg in what will become a trading range, or a bear leg in what will become a weak bear trend. Here it became a bear leg in what was a trading range to this point, and then we got a bull breakout. Bear breakout, but probably bear leg in a trading range, and not likely the start of a strong bear trend. Here we got a bull breakout bar. We're trying to break above the top of this bear channel, a higher low, double bottom, maybe a higher low major trend reversal. But look at the follow through. 4 bull bars, yes, but where are the consecutive big bull bars closing on their highs? Traders are confused. Maybe it's big down, big up, big confusion, and trading range. This is not a strong rally, not a strong bull breakout. So you have to assume we'll get a deep pullback. Here we pull back to about 50%. Here we have a good-looking bull bar, but terrible follow-through. So you have to assume a deep pullback. In fact, we got a reversal instead of simply a deep pullback. Bear breakout, deep pullback. It remained a trading range until this point, so it remained a trading range for a lot of bars. A rally, but no consecutive big bull trend bars closing on their highs. Prominent tails on tops of the bars. A lot of trading range price action to the left. The middle of all of that price action, so the middle of a trading range. This is more likely simply a deep pullback in this bear trend than the start of a bull trend, or it's a bull leg in a trading range rather than the start of a bull trend. Ultimately, we did continue up, but at this point, the odds are it's probably a bull leg in a trading range. You have to assume there'll be a deep pullback or the market will continue sideways for a lot of bars. Here we pulled back about 50% of the height of the bull breakout. Probably a bull leg in a trading range. And the market did remain in a trading range for about 10 more bars or so. In this video, I began by talking about big breakouts occurring after 20 or more bars into a trend. Will the breakout lead to an exhaustive move, a trading range or a reversal? Or instead, is it the start of a new accelerated leg, a measuring gap? Finally, I talked about how weaker breakouts tend to have deeper pullbacks, and they occur more commonly in broad channels and in trading ranges. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 7 videos on breakouts. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 6th of 7 videos on breakouts. In this video, I'm going to be talking about failed breakouts and how they can lead either to trend resumption or a trend reversal. Remember, a breakout is simply a trend bar. It can be 2 or 3 trend bars, it could be 10 trend bars, but a breakout is simply a trend bar. Here we have a breakout that lasted 3 bars. We have 3 consecutive bull trend bars. And then we have an attempt at a failed breakout. We have a bear bar closing on its low, and the bears are trying to end the breakout. They want the market to reverse back down. If this failed breakout fails to stop the trend, then you get trend resumption up. And that was the case here. We have a bull breakout, an attempt at failure, but the failure failed. So you have a failed bull breakout, yet it became a bull flag and the bull trend resumed. We have another bull breakout here. We have a bull bar, a bull trend bar, so it's a breakout. We have consecutive bull trend bars. So the consecutive bull trend bars created an even bigger breakout. We had a 1-bar breakout, and now it became a 2-bar breakout. And it's followed by a bear bar. The bears are trying to get the bull breakout to fail and reverse. In this particular case, the failed bull breakout, so we have a bull breakout, it's failing, it led to a trend reversal down. Remember, we had a bull breakout here, a failure, yet it was followed by trend resumption up. Here, we have a failed breakout, and it was followed by trend reversal down. We have a bear channel, so a bull flag. It's about a 50% pullback of this initial rally. And we have a bull breakout. We have a bull bar here, so it's a breakout. And the breakout extended for another 5 bars. So you can say the 6-bar rally is a 6-bar bull breakout. And then here, we're in a bull trend, and we broke below a bull flag, and we broke below a bull channel. We have a bear breakout. 4 consecutive bear bars. None is especially big. This is pretty good. We have consecutive bear bars here, and then a doji. It's a breakout, but not particularly strong. Remember, every trend bar is a breakout, and every bar with a prominent tail is a failed breakout. Almost every bar on every chart is either a breakout, a failed breakout, a reversal, or a breakout pullback, a flag. Bull breakout, and the bears tried to reverse. Their reversal failed, and it became a bull flag, and it was followed by trend resumption up. Traders will bet the breakout is strong enough, the context good enough, a 50% pullback in a bull trend. Micro double bottom down on that bear bar, and then up and down on that bear bar. So bulls will look to buy a breakout above that micro double bottom. The neckline is the bull bar here, so they'll buy above the bull bar. It's the same price as buying above that bear bar. In either case, they're going to be buying with a stop. Maybe they'll buy the close of that bull bar. Maybe they'll buy 1 pip above the high of that bull bar. In any case, they're viewing this attempt at a failed bull breakout as a bull flag, and they're buying as it reverses up, betting that the bull trend will resume. Here we have a bear breakout, an attempt at a failure, bear breakout. Bulls are hoping to create a failed bear breakout, about a 50% pullback from the bull trend, maybe a breakout test of these highs. We have a high, we broke above it, and now we're pulling back, testing it. The bulls are hoping that this bear breakout will fail and reverse up. Bears are hoping the opposite. They're hoping that the bear breakout will succeed and lead to a measured move down, or at least low enough down to make a profit. We tried to reverse up. The bulls are trying to make the bear breakout fail. The bears are betting the bear breakout will be successful. They'll place stop orders to go short just below the low of the prior bar, and they would be filled right here. And they did get enough down for at least a scalp. Every trend bar is a breakout. Every series of trend bars is a breakout. A breakout can be a single bar, and it can be a series of bars. Here, we have a pair of consecutive very big bear trend bars. You can say the breakout began there, but I think the breakout began here. I would view this as a 2-bar bear breakout, yet it's a 5-bar bear microchannel, 5 bars down without a pullback. It's a strong bear breakout. the bulls are giving up. Bulls are selling out of their longs, and bears are selling into shorts. Strong bear breakout, you have trapped bulls who have not yet exited their longs. They're hoping for any kind of a pullback so they can get out with a smaller loss. You have bears who saw this happening, but for whatever reason did not short, and they're trapped out. They're looking for any kind of a pullback so that they can short at a higher price. We have a reversal, bear breakout, and an attempt at a failed bear breakout. But look at the reversal attempt. A lot of bars with small bodies, prominent tails, and a lack of consecutive big bull bars. We have a pair of bull bars here, consecutive, but small compared to the bear breakout bars. So this is probably a minor reversal, which means either a bear leg in a trading range or a bear flag. And in either case, you'll expect at least a small second leg down. Here we got trend resumption down, not simply a dip in a trading range. So this became a bear flag in a trading range instead of a bull leg in a trading range. This rally is mostly from bears taking profits, trying to reduce their risk. So if they short, their stop is now far away, and the best way to reduce that risk is by reducing their position size. So you have bears buying back part of their position, taking partial profits. Whenever I see a breakout, we have a bull breakout, and then I see a reversal, a failed breakout, I'm always comparing the strength of the breakout and the reversal. Here, we don't have much information, so maybe we have to look at some additional bars. We have a weak breakout up and a fairly weak breakout down. We have a bear bar, but a doji follow-through bar, and it's still a higher low. Bull breakout, but no consecutive big bull bars closing on their highs. We have a bear breakout, but no consecutive big bear bars closing on their lows. Bad follow-through. The bulls have a breakout, but look what it's followed by. And we have a bear breakout, and look what follows the bear breakout. A lot of overlap, and gaps are filled immediately or pretty quickly. Gap, this closed that high. Tried to get a gap here, but could not close above that bar. Whenever a situation like this is unclear, bull breakout, possible reversal, possible bull flag, things are unclear, usually that means sideways, usually better to wait. Wait for more bars, wait for more information. Here, bull breakout, bear breakout, big up, big down, actually a small version of it, leads to big confusion and sideways. This is bad context for taking trades. The range is so tight, very difficult to make money, even for scalping, even with limit orders. There's no significant buying or selling pressure. Alternating bull and bear bars, prominent tails, small bodies, lots of little dojis, a very tight trading range. Better not to trade. Is one side clearly stronger here? Are the bulls clearly stronger? It's still lower highs. Are the bears clearly stronger? No. If one side is clearly stronger, then that increases the chances that that side will win and will get a breakout in that direction. At this point, is it still unclear, or is one side clearly stronger? The bears have a bear bar closing on its low. It's a big bear bar. It closed below the low of the past 20 or 30 bars. The bears are clearly stronger. The odds are we're going at least a little bit lower. We have 3 consecutive bear bars, a very big bear bar closing far below the lows of all the prior bars. Odds are 60% chance this bar will result in some kind of a measured move down. So chances are we're going lower, and that's why the bar looks like this. Everyone saw it as it was forming. It was becoming a big bear bar, and traders were selling, betting that it would go lower quickly. It might pull back, but it may simply go straight down. So a lot of traders were willing to sell right away just in case there is no pullback. Good context for a breakout, a successful breakout. We're in a tight trading range. We're in breakout mode. One side is probably going to win. And then we got a bar, a huge bar, big gap between the close of the bar and the low of the prior bar, the close of the bar and the low of the past 30 bars. Lower prices are likely. The bears are clearly stronger. Bear breakout, and look what followed. Good follow through, big bear bar closing on its low. That increases the chances that we're going lower. Now we have 4 consecutive bear bars, all closing on or near their lows. Chances are the first pullback, traders will sell it and we'll get at least one more leg down. Bulls are hoping for any kind of a pullback so they can sell out of their losing longs. Bears are hoping for any kind of pullback so they can sell at a higher price. Strong breakout like this probably will result in at least a measured move down from the open of the first bar of the breakout to the close of the final bar. We may get other bars in this breakout, but at this point, this is the final bar of the breakout. And you can see we fell for about a measured move down from the open of this bar, close of that bar. Again, tight trading range, very big bear breakout, fairly prominent tail, but a close below the low of the prior bar, close below the low of the past 10 or 20 bars. Traders need follow through. It's possible that this is simply a trap that will reverse immediately up. Big bear breakout, need follow through. The bears prefer to get it on the very next bar, but sometimes it doesn't come in the next bar. Sometimes you'll get a rally for several bars, 5 bars, 10 bars into a bear flag, and then you get the second leg down. If you do not get follow through selling fairly soon, the market can reverse up. If you go sideways for 10 bars, 20 bars, the probability of the bears getting a second leg down drops. And after about 20 bars, the probability of a second leg down becomes the same as the probability of a reversal up. The market becomes neutral. Maybe after 10 bars, maybe after 20 bars. At some point, it becomes neutral again. Look at this. We have a great bear bar, but look what followed. If this was a trading range day or a broad bear channel, traders would look at this and say, it's a second leg trap. I'm going to buy above the high of this big bull bar, betting that this is just a trap, trapping traders into selling low. At this point, we have big down, big up, confusion, big confusion. You have to assume sideways, and then the market is in breakout mode. At this point, we totally reversed the bear breakout, and we went sideways. So even though it's only about 10 bars, I think the market's completely neutral. 50% chance the next move will be up, 50% chance the next move will be down. The bears gave up. It's a failed bear breakout. This bull bar, to me, means it's a failed bear breakout. This bar going above that bar confirms the failure. Failed bear breakout does not mean bull trend. It just means the bear trend has ended and now the market is neutral. In this particular case, it did lead to a reversal. Bear breakout, very strong. Bull breakout, equally strong. Market is neutral. And we entered a triangle, and then we got a bull breakout. Possibly the start of a bull trend. Here, we have a pretty strong bear trend, lasted about 20 bars, very tight channel. We're getting a bull breakout. Usually, if you get a bull breakout above a very tight bear channel, the first reversal up is minor. Usually the market has to go up 5 or 10 bars, and then the trend resumes. If the bulls at that point can reverse it up a second time, some kind of a double bottom, maybe slightly higher, maybe slightly lower, they create a major trend reversal, a major reversal. But at this point, the odds are this reversal will be minor. Usually the first breakout above a protracted bear channel, a tight bear channel that lasts a lot of bars, is minor. The bulls have a micro double bottom. They have a possible 1-bar final flag, and they have a big bull bar closing on its high above the high of the past 6 bars. All good for the bulls, yet probably minor. Minor means the first reversal up probably will not get very far. So what happens? Bears will look at that and say, we got a strong bull bar, but it's probably a minor reversal. It probably will fail around the moving average. I'm going to sell the close of that bull bar, betting that it's going to be a failed bull breakout. That is a logical thing to do. More likely a minor reversal and a trading range or bear flag than the start of a bull trend. Not much risk selling a strong bull close at or near the moving average, betting the bull reversal will fail, because it probably will. Other traders will say, okay, I don't want to sell a big bull bar, but we have a bull breakout with a bear bar closing on its low. I will sell below the low of that bear bar, betting that the bull breakout is failing and that it's a 2-bar bear flag and the bear trend will probably resume. We're reversing up again here. This is a second reversal up, so it's a double bottom. I know this low is far below that low, but it's still a type of a double bottom and possibly a major trend reversal. I said this reversal, first reversal from a tight channel, minor, but that if we do get a resumption of the trend down and then another reversal, that could be major and lead to a change in the direction of the trend. The major trend is down, and now the bulls have a chance of turning the trend into up. Here we have 4 consecutive bull bars, and 2 of them are very big. 2 of them are closing on or near their highs. In fact, this is closing near its high as well. This is a strong enough reversal so that probably at least a little bit more up is likely, maybe a measured move up. Also, the context is good. It's a double bottom after a pretty good breakout above a very tight channel. So this could be a lower low major trend reversal leading to a major reversal of the trend. A major bear trend, maybe the start of a major bull trend. At this point, we're still getting lower highs. So we're still in a broad bear channel. But this is a pretty strong reversal following fairly closely after this bull reversal. It increases the chances that we're going higher. The overall bear channel still fairly tight, not too many bars up, possibly still a minor reversal. In fact, it did become a reversal. You want to call it major, you want to call it minor. It was enough for traders to make a swing trade. I would call it a major reversal, but not enough to get above the top of the bear trend. And what we got was ultimately a trading range. At this point, after this much of a reversal, traders will look at the next reversal up as a major trend reversal. Is it a higher low major trend reversal? With 5 consecutive bear bars, probably not. It's probably more big up, big down, big confusion, and sideways. However, here we have a double bottom, slightly lower low, double bottom, a micro double bottom. This has a better chance of becoming a higher low major trend reversal. In this video, I talked about failed breakouts and how they can become flags and lead to trend resumption, or they can lead to a reversal. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 6th of 7 videos on breakouts. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 7th of 7 videos on breakouts. I'm going to begin by talking about 5 tick traps and 11 pip traps, where the market goes almost far enough for a scalp and then reverses. Finally, I'll talk about fading weak setups. E-mini traders, the scalpers, they often take profits at 1 point, or 2 points profit, or 3 points profit, 4 points profit. 1 point is 4 ticks. 4 points profit is 16 ticks. That means that any move that is 4 ticks, 8 ticks, 12 ticks, or 16 ticks creates support and resistance. For example, if a bull buys above the high of this bar, looking for a scalp, a 1 point scalp, he buys 1 tick above, He places a limit order to sell 4 ticks above that, so that's now 5 ticks above this bar. That limit order probably will not be filled unless the market goes 6 ticks above this high. For the bulls to make a 1-point scalp, the market usually has to go 6 ticks above the high of this bar, and it did. This is 6 ticks above that, so bull scalpers were able to make a profit, a 1-point profit. If a bull's trying to make a 2-point profit, the market usually has to go 10 ticks. If he wants a 3-point profit, it usually has to go 14 ticks. If he's expecting a 4-point profit, the market has to go 18 ticks. And that means 18 ticks above a reasonable buy signal bar, there is resistance. Bulls will be selling there to take profits. If the market goes 1 tick less than these targets and starts to reverse, then those scalpers are trapped. So for example, if it goes 5 ticks instead of 6 ticks and starts to reverse, the bulls were unable to get their 1-point profit, and now they're trapped, and a lot of them will start to sell. Let's say a bull buys on a stop 1 tick above this bar, betting on a failed bear breakout, a decent bull bar. Here, the market rallied 10 ticks above that entry price. So a bull looking for a 2-point profit was able to scalp out at 8 ticks. He buys 1 tick above the bar. It has to go 9 ticks above his entry price to make an 8-tick profit and went 10 ticks. This is not a trap. The bull successfully made 2 points on their scalp. On the other hand, let's say a bull looked at this and said, we have a wedge bottom, 1, 2, 3, or 1, 2, 3, a spike in channel bottom. We're probably going to get a swing up maybe to the top of the bear channel. So the bull buys 1 tick above the high of this buy signal bar, looking for a swing up 4 points. It has to go 18 ticks above the high of this bar for him to make his money. He buys 1 tick above right here. It has to go 16 ticks higher for his 4 points. And for his limit order to get filled, it has to go 1 tick above that. It has to go up 18 ticks above the high of the signal bar. If it goes up 17 ticks, it hits his limit order to make 4 points profit. Most of those traders would not get their profit. Their order would not be filled. And then when they see this, they have to be thinking, uh-oh, it hit my limit order, did not fill me, and now we have a bear bar. So maybe I'm trapped. Maybe this is a 17-tick trap. A lot of times, traders will look at a chart like this and say, well, it's a possible 4-point swing, but maybe it won't hit 4 points. I'll place my limit order 1 tick lower. So they'll try to get out with 3 3/4 points profit. In other words, they'll try to exit with 15 ticks. And that is part of the reason why you get the 17-tick trap. Traders looking at this saying, well, maybe it won't quite make 4 points. I'll place a limit order 1 tick lower. And that's part of the reason why the market will go to the 17 ticks and reverse down. You'll have some bulls exiting with 1 tick smaller profit. Bear scalpers, when they see the market hit a target for the bulls, they'll sell the reversal down, betting that the bulls will be exiting. Here, you have bears selling, betting on the lower high, 2 legs up, 1 pullback 2. They'll sell below that bar or below this bar. Here, you'll have bears selling, betting that the bear channel will continue. So they'll sell just below the low of this bar, 1 tick below the low of that bear bar. And look what happened here. Bears sold 1 tick below this bar, betting that they'll make at least a scalp. It fell 5 ticks and then did this, reversed up. So the bears who sold just below that bar, they get filled over here, are now trapped. And they'll buy back their shorts. And part of this reversal up is the trapped bears. It had to fall 6 ticks for them to make 1 point. It fell 5 ticks and hit their buy limit order where they wanted to take profits, did not fill most of them, and as it started to go up, they panicked and they bought. So we have a 5-tick trap and reversal. You have some bears who sold below this bar. They get filled here, 1 tick below that low, maybe hoping for a 2-point trade or a 3-point trade. Here, the market fell 13 ticks. Those bears who were hoping for 3 points needed it to fall 14 ticks to make 3 points profit. They sell 1 tick below the bar, and then it has to fall 12 ticks to hit their target. It has to go 1 more tick, total of 14 ticks to make 3 points. And instead, it fell exactly 13 ticks and reversed up. So it's a 13-tick trap. Actually kind of a dumb thing to place a buy limit order at that price in this particular case, because it has to fall below this low, and I think that's not a high probability bet. If I were taking this for a 3-point trade, I would try to get out 1 tick above 3 points. So I'd get out 1 tick above this low, just in case we got a perfect double bottom, which we did. As I said, sometimes traders who are not entirely confident that the move will fill their profit target will go for 1 tick less. Bulls hoping for 4 points, look at this, say it's not all that good. Maybe instead of trying for a limit order 16 ticks above my entry, I'll place it 15 ticks. Same with here. Bears selling here, thinking it has to fall below this to get 14 ticks for them to make 12. They'll place a limit order to get out 1 tick early. Here, I would not take that short, and I certainly would not place my limit order looking for a 3-tick profit. For me, the minimum scalp in the E-mini is 1 point, so I'm never going to be going into a trade planning to get out with 3 ticks instead of 4 ticks. Think about it from the perspective of traders looking for trades in the opposite direction. For example, here, bulls will think, okay, a lot of the bears know this is probably not going to fall very far, and a lot of the bears will probably be scalping for 1 point. It has to fall 6 ticks, so maybe I'll place a limit order to buy 4 ticks below, just in case it's a 5-tick trap, then I'll get filled. And the opposite is true here. A lot of bears will look at this and say, yeah, it's a strong rally, but it's probably not going to go above this high. Maybe it'll stay another lower high. And they know a lot of bulls will look to take profits at 4 points. So they know a lot of bulls have limit orders 17 ticks above this high. You'll have bears placing limit orders to go short, at least for a scalp, 17 ticks above this high. And they also know that this might be a 17-tick trap, so they'll place limit orders 16 ticks above this high. You have bulls and bears selling at 16 ticks above this high, and sometimes you'll get a reversal. A lot of times you'll just get a pullback far enough down for the bears to make a scalp. As I said, the bulls who bought above here for a 2-point scalp needed the market to go up 10 ticks to make their 8 ticks, and they got filled. They made their money. The bears know bulls will take profits there, especially since it's slightly lower than this high. And the bears will short exactly where the bulls are trying to get out. Opposite E-mini traders, the scalpers, are betting that the stop entry traders will not make their 1, 2, 3, or 4 points. So they enter in the opposite direction with limit orders, maybe a tick or two below the target for the bulls. Bears know the target for the bulls is 9 ticks above this. They know it has to go up 10 ticks. So bears will place limit orders to sell 1 or 2 ticks below that. The bears down here know the bulls might be trying for 3 points. The bears need it to fall 14 ticks to make 3 points. The bulls know that. And the bulls also see a potential double bottom. So the bulls will place limit orders to buy 12 or 13 ticks below that low, trying to trap the bears. The same here. The bulls know this is a bad looking short. They know some bears will sell it, maybe only for a 1-point scalp. The bulls know it has to fall 6 ticks for those bears to make money, so the bulls will place limit orders to buy 4 or 5 ticks below that low, betting that the bears will be buying down there as well. If the bears are buying and the bulls are buying, the bulls probably will make money. The bears here, they might sell 4 ticks above this bar and scale in higher, betting that it's a bad buy and the bulls will be only scalping. In other words, the bulls do not have a lot of conviction and will not be holding for swing trades and will not be buying much higher. So they will not continue to buy. Bears will start selling either at this high, 1 point higher, 2 points higher, or maybe they'll start selling at 1 point higher or 2 points higher. And the same true here. The bears will assume it probably will have profit taking around 4 points above this high, and that the market will convert into a trading range, so bears will sell. They might start selling 1 point above, 2 points, 3 points. I would not. The context is good for some kind of a swing up and the conversion into a trading range. If I'm going to be selling at bull profit targets, I probably would start selling at 3 points or 4 points up, 16 or 17 ticks above the high of the buy signal bar. Bulls buy with limit orders 4, 8, 12, 16 ticks below sell signal bars, betting that the bears will take profits there. And the bulls are buying for a scalp, betting on a trading range. Whenever there's a weak buy setup, bear scalpers will sell at the high of the buy signal bar. And they'll scale in 1 or 2 points higher, just below the profit targets for the stop order bulls. Strong bear breakout, trying to get a bull reversal. As I said, some bears will start selling here, sell more 1 point higher, sell more 2 points higher. It comes down to their original entry price. They exit break even on their first order, a profit on this, and 2 points profit on that. Here we have a bear inside bar at the bottom of a weak channel, and it's possibly a wedge channel after a bear breakout, so it's possibly a spike in channel bear trend. The bear sell signal bar has a fairly prominent tail. A lot of bulls will bet it's a bad bear flag. They'll place a limit order to buy at the low of that bar, and they'll buy more 4 ticks lower. They'll exit break even when the market gets back to their first entry, and then with a 1 point profit here. Some will hold in case we get a continued rally. Whenever you have trapped scalpers, other scalpers will do the opposite. You have bulls and bears buying at the same time down here. You have bulls and bears selling at the same time up here. That means profit targets create support and resistance. Profit targets for the bulls creates resistance because both bulls and bears will sell at those profit targets. Profit targets for the bears create support because both bulls and bears will be buying at that profit target. Forex scalpers often take profits at 10 pips, 20 pips, 30 pips, 50 pips. And if they enter on a stop, to make 10 pips, the market has to go 12 pips. To make 50 pips, it has to go 52 pips. If the market moves 1 pip less, then it traps traders. For example, let's say you have a bull scalper who looks at this and they see a pullback, maybe testing this high. Maybe this is a measuring gap. We'll get a measure move up. Maybe they'll place an order to buy 1 pip above the high of this buy signal bar, expecting the market to go up high enough for them to make a 10 pip scalp. If they buy 1 pip above this bar and they need 10 pips for a profit, that's 11 pips, it usually has to go 1 more pip before their profit-taking limit order gets filled. So that means traders buying on a stop above the high of this bar usually need a rally that goes up 12 pips for them to make a 10 pip profit. If the market only goes up 11 pips and then reverses down, they do not make their profit and they'll have to get out of their trade. So they could be trapped into a trade. And if the market reverses down at 11 pips, I call that an 11 pip trap. This is an example. Bulls might buy 1 pip above the high of this bar, have limit orders to sell 10 pips above their entry, which is 11 pips above the buy signal bar. And then if it starts to drift down, these bull scalpers will be trapped. They'll be still in the trade, but without their profit. And at some point, they give up. The bear scalpers know that the bulls will try to get out with a 10 pip profit. Fairly small day, so a lot of bulls will scalp for 10 pips. So the bears will place limit orders to sell 10 pips above the high of a buy signal bar, betting that bulls will be selling there as well. Here, let's say we have bears expecting that you'll have trapped bulls and we'll get a reversal down. This is a final flag. Maybe we'll come down here or below. In any case, let's say bears sell 1 pip below the low of this bull bar. The minimum scalp in Forex markets is 10 pips. The market therefore has to fall fall 12 pips below this bar to make a profit, to make their minimum scalp. They sell 1 pip below the bar. It has to fall 10 more pips to hit their limit order. And for that limit order to be filled, it usually has to fall 1 more pip. So the market usually has to fall 12 pips for the bears to make 10 pips. If it starts to turn up before 12 pips, it's an 11 pip trap. That means the bears who sold are trapped. It hit 11 pips. Most of them did not get their 10 pips profit, and it reverses up. At some point, those bears give up. A lot of times, if traders are concerned as the market's falling, let's say a trader sells below this bar, and he's concerned that it's not falling as fast as he wants, he may change his order and try to get out 1 pip early. So instead of placing his order to make a 10 pip scalp, he'll try to get 9 pips. And that means that there'll be support 10 pips down. The market has to fall 11 pips for him to get filled with his order 10 pips below the sell signal bar for him to exit with a 9 pips profit. Also, you'll have opposite traders believing that the bears are scalping. So the opposite traders are the bulls, and they'll expect support around this low. They'll think most of the bears will scalp out for 10 pips. So the bulls will look to buy around where the bear scalpers will be taking profits. The bulls will place limit orders about 10 pips below the low of this bar. The market has to fall 11 pips for those bulls to get their order filled. So you have bulls trying to buy 10 pips below this bar. You have bears trying to buy 11 or 12 pips below that bar. And that can result in the market not quite filling the bears. If enough bulls are buying and if enough bears are raising their limit order by 1 pip, a lot of times the market will fall 11 pips instead of 12 and reverse up. And that results in an 11 pip trap. Here, some bears might look at this and say, well, I don't know, maybe it's a 50% pullback, maybe we'll get a double bottom, maybe I was wrong trying to get 10 pips, maybe I'll exit 1 pip early. Bulls know that, and they'll also be buying at the same price, maybe about 10 pips below the low of this bar. Has to fall 11 pips to get filled. So sometimes you'll have so many buy limit orders, both bulls and bears buying, 11 pips below the low of the signal bar, that the market does not fall 12, and you get the reversal up, and you get an 11 pip trap. Bears trying to get out with 10 pips profit are now trapped. They do not get filled, and they have to exit, and they gave up in here. Different data from different brokers. Also, there are mini pips, so instead of 11 pips, it could be 11.3 pips, 11.9 pips. Also, because some charts only show the ask, the offer, and not the actual trades, you might not get filled even though it looks like you're getting filled. So Forex traders trying to scalp for 10 pips, difficult thing to do. Most Forex traders should not be doing that. But experienced Forex traders can do that. But they can only do it if they can think fast. They have to make quick decisions. I want to talk a little bit about fading weak setups. Fading means doing the opposite. So if there's a weak buy setup, traders will sell. Let's look at this. We're selling off and we're trying to reverse up. Some bears will look at that and say, oh, that's not a very good buy signal bar, especially after such a big bear bar. I bet the buy signal is going to fail. So the bulls buying at this high on a stop, or 1 tick above this high on a stop, are probably trapped, or they will get trapped. So the bears will sell with a limit order exactly at that high. They'll sell at or slightly above. A lot of times I'll just place a limit order at that high and get filled right there, betting that it's a bad buy. Protective stop, either above the top of the sell climax or the top of the bear trend. My stop is up here. A lot of times when I take that short, I'll place a limit order to sell more 1 or 2 points higher, betting that it might go a little bit higher, maybe a 50% pullback, but odds are my stop will not get hit before I'm able to make a profit. So the bears sell this high and they sell more 4 ticks higher. It has to bounce 5 ticks to get filled. The bulls know their buy setup is weak. A lot of the bulls are simply trying to scalp for 4 ticks. It has to go up 6 ticks to get filled. We have a buy signal bar with a bear body after a very big bear bar. It's not a strong buy setup. Plus, it's following a big bear bar. If the market goes up 5 ticks, it therefore hits the limit order for the bulls. So the bulls buy 1 tick above this bar. They get filled on that gray line right there. They place a limit order to take profits 4 ticks higher, which is this gray line. And you can see the market exactly hit their limit order. If it does not get filled pretty quickly, those bulls will get out, afraid that they'll be trapped, a 5-tick trap. So bulls and bears are both selling there. The bears are selling, betting that it's a weak buy signal, and the bulls are selling there as well. We have a lot of limit orders, 4 and 5 ticks above the high of a bad buy signal bar. And that can result in the price falling pretty quickly. Many of these bears, they'll sell the high of this bar and 1 point higher. They'll take profits at their first entry price. So they get out break even on their first sell and with a 1 point profit on their second. And the bulls who bought on a stop 1 tick above this bar, when it's reversing down, they're trapped. They're trying to get out break even. So you have bulls and bears selling. Some of the bears will swing part of this. A lot will just simply scalp, depending on the context. If this is part of a huge bear trend, a lot of the bears will not take profits here. They'll hold for a swing down. The opposite is true if bulls think the bears have a bad sell setup. Bulls will buy the low of a bad sell signal bar. We have a bear trend. Maybe this is a bear flag. It lacks consecutive big bear bars, and we have a pretty good reversal bar here and a second bull bar here. Bears selling here are taking a chance that they'll get stopped out with a losing trade. A bad sell signal bar, and therefore a lot of bulls will buy at that low, betting that the bear breakout will fail, and they'll look for a scalp. They might buy more 10 pips lower, but it requires an 11 pip sell-off for them to be able to scale in 10 pips lower. These are scale-in bull scalpers. Here we got a 14 pip sell-off. Bulls who bought this low, betting on the bad bear flag, they buy more 10 pips lower. It fell 14 pips, so they would have been filled. Again, bulls only do this if they're confident that this is a bad bear flag and that it's going to lead to a trading range or even a rally instead of a continued bear trend. Bulls doing that, they might have to risk about 30 pips from their first entry. So they buy here, buy more 10 pips lower. Maybe they're willing to buy more 20 pips lower. In general, if you're doing that kind of trading, you have to risk about 3 times the size of a minimum scalp, 10 pips. So you have to risk about 30 pips. Most traders should not be doing this. They certainly should not be doing the scaling in. Experienced traders do it regularly. The bears know that selling below this bar is a bad short, probably not going to be profitable. We have a bull body and consecutive bull bars and a weak sell-off. Arguably a wedge, 3 lows, 1, 2, 3. Might get a couple legs sideways to up. And these bears will be quick to buy back their shorts. Most of them, if they are scalping, are just looking for 10 pips. That means that there'll be a lot of buy limit orders about 12 pips or 11 pips below this low. So if the market falls 12 pips, probably buyers. Weak bear flag, so probably buyers at the prior low. Bears will be buying at the prior low to take profits. Bulls will be buying at this low, betting that we'll bounce up enough for a scalp. And bulls know that, so they'll buy here, they'll buy more 10 pips lower, betting on a trading range. They can exit their entire position at their original entry price, getting out break even on this first buy, and with a 10 pip profit on the second buy. Some bulls will not buy this low. They'll simply take the second entry 10 pips lower. Other bulls will say a new low probably will fail, and they'll simply place a limit order to buy at that low. And they'll try to get out at the place where theoretically bulls would begin to start to buy at this low. So profit-taking area. If traders think the context is good enough for a swing up, they might swing part. But in general, small bars, prominent tails, small range, traders are scalping. In this video, I talked about 5 tick traps and 11 pip traps, where the market goes almost far enough for a scalp and then reverses. And finally, I talked about fading weak setups. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 7th of 7 videos on breakouts.